Hey everybody, good morning to you. Welcome, welcome, welcome. My name is Laura Bolio, and I'm the head of marketing here at Holistiplan. I'll be your host today. So this is our very first keynote that we're doing this year. This is a new series that we're kicking off, and we're super glad that you're here. So this one is all about setting the foundation for the future, especially as it relates to tax planning. Couple of announcements. The number one question we get asked, despite being a tax planning company and having questions about tax planning, the number one question that we get is, will this session be recorded? And the answer is yes, absolutely. So we will send out the recording by the end of the week in a follow-up email. If you have any questions throughout any of these sessions today, please feel free to drop it into the Q&A. We'll have people monitoring the chat. And so anything that gets dropped in there, we will answer. And anything that we miss will get addressed in the recap email. The other thing I wanted to mention is we just launched a brand new website about 2 weeks ago, and we have a new feature that I'm super, super pumped about. That is a webinars page. You know that Holistiplan does a ton of webinars, a lot of educational content. And so if you go to Holistiplan, to the resources tab, there's a webinars page underneath that. And you can go ahead and pre-register for all of our upcoming webinars so that you can make sure you can always see what's coming next. The agenda for today is a really good one. So we're going to kick it off with Jeffrey Levine. He's going to be talking about the TCJA and the 20% pass-through deduction. Then we're going to have a brief policy discussion between Jeffrey and Roger. After that, we're going to have Jennifer Fensley and Allison Doty from Cap South. They're going to be talking about going 0 to 1 for tax planning. If you haven't seen these two present before, you are in for a real treat. And then we're going to wrap it up with Roger Pine and Ben Birken. They're going to be talking all about Holistiplan's Roth projection tool, which is a brand new feature. All right, so Mr. Jeffrey Levine, he is the lead financial planning nerd for Kitsies.com. He's also the chief planning officer at Focus Partners Wealth. And in 2020, Jeff was named by investment advisors as one of the top 25 voices to turn to during uncertain times. Jeff is a past recipient of the Standing Ovation Award, presenting by the AICPA Financial Planning Division, and he was named to the 40 Under 40 by Investment News. So Jeff, if you want to come on screen, I can stop sharing and then we'll hand it off to you and you can kick it off.
Absolutely. Good morning, and thanks, Laura. And it's great to see everyone. I always love being here with my friends over at Holistiplan, and we're going to talk today about a topic of renewed importance, I think, given the current climate we're in. As you heard Laura mention, we will talk about what's coming down the road here with Roger. A little bit at the end of my discussion, we're going to have like a little bonus time talking about what's coming. But, spoiler alert, one of the things that is likely to be here next year is the 20% pass-through deduction. And that's why, when we were talking about what's a good topic for us to do this session, we said, what's something that is really meaty that maybe advisors haven't paid as much attention to in the recent past. And in fact, this is one area where I've been out on the road and people have said, I'm not going to spend all that time diving in and learning this now because at the end of the day, it's going to go away in 2026. Well, it's probably not going to be going away in 26 anymore, right? In all likelihood, the 20% pass-through deduction, the QBI deduction, the qualified small business deduction, the 199A deduction, whatever you want to call it, right? That deduction that is for business profits is likely here to stick around for the foreseeable future. And so with that in mind, what I want to do with our next, 55 minutes or so is to make sure that when we leave here, everyone has a really sound understanding of, one, how this thing is actually calculated. Now, is my goal for you to be able to turn around and, do tax returns with it? No. But I do want you to be able to, for instance, pull up Holistiplan and be able to model a scenario in there And also to think about like what are the what are the sort of planning strategies that I can bring to bear on my client's situation to help them get more out of this deduction. Remember, this could be a 20% deduction on business profits. If you've got a high income client making $500,000 a year from their business, that's a potential $100,000 a year deduction each and every year. So there is a lot of bang for the buck if you take the time to really go through this. And I'll share with you just at a high level, when I review returns of business owners, I would say, upwards of 3/4 of the returns that I look at, or I shouldn't say the returns, but the situations I look at, there are things that the business owner could do to be more effective with their tax planning to squeeze a little bit more out of this deduction. So we're going to talk first about how is this calculated, and the basis, the reason for that is simply different businesses have different strategies, but you have to understand how the basic framework of how the deduction is calculated in order to be able to understand which strategies you can bring to bear on your client's situation. So let's start from the beginning. First off, what businesses are eligible for this deduction? And simply put, it's pass-through businesses. So that includes sole proprietorships, it includes S corporations, or really businesses that are taxed as S corporations. There is no such thing as a quote unquote S corporation, right? Like we talk about that all the time, like, oh, I have an S corp. No, you don't. You either have a corporation or you have like an LLC, and you might have an S corporation election on it, but there's no way to go to your state and create an S corporation. You create an LLC, you create a corporation, and then a federal tax election is made. Now, partnerships, also another one, and excuse me, and other pass-through entities, things like LLPs and whatnot. As a reminder, if you do have questions, technical questions, feel free to throw those into the chat, the Q&A box, and periodically you'll see me, glance over here to the side. I've got a separate monitor up, and I'll address those. So I do see one question here. It says, welcome, the Hammer. Are there any relevant updates from Secure Act 2.0 that came out last year? There are a ton of things related to that, and if we have time at the end, I will gladly turn to answer those questions. But for the sake of making sure that we get through our QBI deduction, I'm going to sort of try and lock it in here, if you will, on the QBI deduction stuff, at least for the time being. So as we move on here and we talk about our next topic, the QBI deduction is for, QBI stands for Qualified Business Income. Again, I'm going to repeat that. It's qualified business income, right? With the emphasis on the word business. So why is that important? Well, because the word business is not actually well defined in the tax code. In fact, there are a bunch of different definitions out there. And when the regulations first came out years and years and years ago, the proposed regulations, you can see here on the screen, they've since been finalized. Everybody was sort of hoping, like, boy, please don't use the definition of 162. Please, IRS, choose anything other than that. And of course, the IRS chose Section 162 just to make our lives more difficult. And the reason why tax preparers everywhere did not want that was it's just not well defined. Section 162 basically says you got to be engaged in a business for profit. It has to be regular and continuous. And while in many instances, it's pretty clear, right? Like, oh, yeah, that's a business. There are a lot of times where it can get a little bit murky. Real estate is one of the biggest ones here. For instance, rental real estate can certainly qualify as a business, right? Now, we're not talking about like in the business of like that's your regular job, but just the 162 definition. Are you engaged in this regularly, continuously, and for profit? Well, a lot of businesses qualify, or real estate businesses, but what if your client has like a triple net lease property, right? Just as an example of where this can get murky. What are they doing? Yeah, they're engaged for a profit, but what are they doing regularly and continuously, right? What are they doing on the regular that would make this a 162 business? Are they going to the bank once a month to cash the check? I mean, like a triple net lease, right? Everything is done. You're just cashing. And even today with technology, you may not even have to actually go to the bank to cash the check. So what are you doing? This is where, relying on your client's tax preparer or some other sort of tax professional, a tax attorney in some cases can be important. Again, deciding whether or not the thing that your client does that generates income rises to the level of a business. Again, in most cases, pretty clear, but not all. All right, but we're going to assume for the rest of our discussion, your client has a business. The next question is, how much do they get as a QBI deduction? And at a very high level, we've got here a sense that the deduction is equal to the lesser of two things, either combined qualified business income or taxable income before the application of the deduction and less capital gains. So let's talk about each of these in a little bit greater detail, right? First off, combined qualified business income. I've got a slide here coming up that really illustrates that, but combined qualified business income is itself a combination, hence combined qualified business income, of two things: combined REIT and publicly traded partnership income and your client's actual business income. The second element here, taxable income before the application of the pass-through deduction, less capital gains. Effectively, what this is saying is taxable income, but you can't look at it after. It's like a circular calculation almost, right? Because true taxable income is looking at income and then already backing out your QBI deduction, because that's how you get to taxable income. You look at things after all of your deductions. But if you did that and then phased out, like, you'd have this weird circular calculation going on there. So effectively, we need to look at what is your client's taxable income before we even apply the QBI deduction, and having already backed out capital gains. And here, that definition of capital gains includes qualified dividends. So basically, you need to look at your client's return and say, okay, how much in dividends and qualified dividends, how much in capital gains did they have? We'll subtract that from a taxable income amount, and that will be the income we use to determine this 20%. And that's it. And then effectively, it's 20% of the lesser of those two amounts. So again, let's talk a little bit more about this in graphic form. So here's a visualization of what it looks like to calculate combined QBI. Okay, this is what it looks like to calculate combined QBI. Effectively, on the left side of the screen here, what you see is a funnel where we put in publicly traded partnership income and qualified REIT dividends. And then what happens is we add those two up, and to the extent that they're positive, we're going to drop that amount down into our combined qualified business income piggy bank, if you will. Now, if it's a negative, then it goes to the side and it's held sort of in suspense to offset future years' positive REIT dividends and publicly traded partnership income. And while you can't really have negative REIT dividends, there's no way to like negative that, you can have negative publicly traded partnership income, right? Your client gets a K1 from the MLP they're invested in, and that is going to, that has a loss in box one. Well, that could more than offset their REIT dividends. That would be a net loss between the two of those, right? Added up their publicly traded partnership income, added up their qualified REIT dividends. It was a negative number. The negative number does not go down into the qualified business income piggy bank. Instead, again, it's sort of held off to the side to offset future years' positive income on that side. We only drop positive numbers into our combined qualified business income piggy bank. Now, on the other side of the screen, we've got your client's total qualified business income. We look at all their businesses, we add them up, we take the gains from the businesses that have gains, we offset them against the businesses that have losses, and we say at the end of the day, is that a positive number? If it's not, if it's a negative, if your client has a net loss from their businesses, that gets held to the side and will offset future years' business income that's positive. But if it is a positive, and hopefully it is for your client, then again, it goes down into our combined QBI piggy bank. At that point, we've got our combined qualified business income. It's the net positive from the left side, our positive publicly traded partnership income and REIT dividends, and the right side, our positive business income. Those two net positives combine to create qualified business income. Now, Then the next step is simply to say, is the amount in that piggy bank more or less than 20% of that taxable income amount we talked about? So here's the next slide. I just switched it. And everything from the piggy bank up is exactly a photocopy, if you will, from the last slide. The only difference here is now I'm saying, okay, is that piggy bank more or less than 20% of the client's taxable income? Again, with all those adjustments. If the combined qualified business income from the business is less, well, then that's the lesser of the two. We'll take 20% times that amount, and that will be the client's deduction. So that might be an example where you've got a client who works and makes $200,000 of business profits, but they're married to someone who has a $400,000 salary. Their taxable income will likely be much higher than their business income. By contrast, if that QBI, that combined qualified business income piggy bank, is higher than taxable income, take somebody who has a sole proprietorship. They make $150,000 a year, and that's their only source of income. Well, off of that, they're going to have things like maybe the standard deduction, and so their taxable income will be less than their business income. Well, if the taxable income is less, then 20% is the way the deduction is calculated there. And that's it. So I want to be really clear here. I already see questions about, hey, I've seen things about SSTBs or this and that. Like, what if a client is in this business? The simple way to calculate this deduction, and we'll talk about how it gets more complex, but that's it. We're done. It's 20% of the lesser of those two amounts. And for a lot of our clients, that's it. There's nothing else we need to do from a calculation perspective. It doesn't matter what business they're in. It doesn't matter how much in wages they pay or anything like that. For a lot of our clients, we are already done. So as complicated as this is made out to be, and it can get that way, for a lot of our clients, it's much more simplified than one would think. We've already got the number in our head. It's the 20% number times the lesser of our piggy bank of combined qualified business income, or if less, their taxable income. Now, as we think about where that deduction is taken, when this deduction was first created, a lot of people were calling it an in-between-the-line deduction. Because it's what's interesting is that it's a personal income tax deduction for business income. So it's a deduction taken on the 1040, right? Even though it's attributable to business profits, something that might come from a 1120S or a partnership return or even a Schedule C, right? No matter where it's coming from a business it's not taken on the business return. It's taken on an individual's personal return, and their personal unique tax attributes will, in many cases, determine how much, if any, of the deduction they get. In other words, two people with the exact same role in the business, with the exact same ownership in the business, with the exact same income coming from the business, can actually report two very different deduction amounts on their personal returns, because the amount that they report can be impacted by other elements on a personal return. As I mentioned, when the law first came out, a lot of people were calling it an in-between-the-line deduction. As it turns out, I think a better way to describe it is a below-the-line deduction, and you'll see why here in just a moment. But you might say, well, Jeff, what is that? Well, first off, I don't really care that you remember my silly name, a below-the-line deduction. But what I do care is that when you're done today, you remember that this is unique. It's a deduction that is in a class all by itself for a few reasons, and one of them is that it doesn't work like any other deduction. Every other deduction you can think of is either an above-the-line deduction, in which case we should know two things. One is you don't have to itemize, right? You could take the IRA deduction and take a standard deduction, right? That's fine. So you don't have to itemize to take the above-the-line deductions. And on top of that, they have the benefit of not only reducing taxable income, but they also reduce AGI. And remember, that's really important, because most things that phase out on a tax return that are good, that are things like credits, deductions, etc., they're phased out based on AGI. And most things that are bad that start happening, things like surtaxes, Medicare Part B premiums, etc., those are things that are also keyed to AGI. So having a deduction that reduces income before AGI is more valuable than one that is reducing income after AGI, because it helps to take care of all of those things or mitigate those things. So we've got above the line deductions, again, no itemization required, and it reduces AGI. A QBI deduction, you don't have to itemize to take it. So that would lead you to say, well, it must be an above the line deduction because you don't have to itemize. But the Tax Cut and Jobs Act was explicitly clear. You cannot use a QBI deduction to reduce AGI. It happens afterwards. So it's, again, in a category by itself. It's the only deduction that you don't have to itemize for, but that comes off after AGI. It's a below the line deduction as it appears on a tax return. Here's a 1040 for, looks like I forgot to change the number at the top. This is 2024, not 2022. You can see the actual image there on the right side. But on this document, right, if we look at the lines, we have total income above it, adjusted gross income is above it. Then after we have adjusted gross income, we're taking the standard deduction or itemized deduction. So we've got AGI there. You can see that on, again, my blown up version here. AGI on line 11. On line 12, we're taking off your client's standard deduction or their itemized deduction, depending upon which they qualify for. And then after that happens, we're saying, by the way, there's one more deduction we didn't account for yet. It's the QBI deduction. Take that deduction now. So it's effectively a below the line deduction. Again, the key takeaway for you is that clients don't have to itemize to take it, but it does not reduce AGI. All right, so now let's move on to talk about the differences in businesses and how that impacts the calculation. I mentioned at a few moments ago that for a lot of our clients, we're done. We've already calculated the deduction. Nothing else matters. And that's true for any what we will call low income clients. Now, low income, what does low mean? Well, low is a relative term, right? Low compared to what? Right? For someone who makes $1 billion a year, $100 million, or someone who has $1 billion, someone with $100 million doesn't have a lot of money, right? Someone with $100 million, someone with $1 million doesn't have a lot of money. Someone with, $100,000, you get the point, right? It's all relative. So we got to define what we mean when we say low, high. Those aren't definitive numbers. Low here for qualified business income tax deduction purposes simply means income below the phase-out threshold, where it starts. And you can see here the numbers for both last year and this year. For married couples, we're talking about almost $400,000 of income. And not only that, what's unique as well about the QBI deduction, I told you it was unique for a few factors. One of them we just talked about, that below the line deduction element. But another one is, it is the only deduction that is phased out based on your client's taxable income. It's not an AGI-based threshold like everything else. It's based on taxable income. So in fact, clients this year might have $425,000 of taxable income if they are married and file a joint return. And then we take off their $30,000 standard deduction, and they're still right at the bottom. So you can have $425,000 of income as a married couple and still, for our purposes, for this deduction, be a quote-unquote low-income client. And the benefit of being low income here is that we don't have to worry about anything else. That calculation we already performed, 20% of the lesser of either combined qualified business income or taxable income, is the calculation for the deduction. We're done. I don't care what business you are. If you're a financial advisor, right? I've heard over the years, like, it doesn't apply to me because I'm a financial. No, it does, unless you make more than this amount of income. But there are a lot of financial advisors that don't make more than $400,000 of income, and they still get a deduction. It does not matter. Okay? It also doesn't matter how much in wages you pay or how much in depreciable property your business owns. None of that matters. If you are a low-income client, with low being defined, as you see here, income below the thresholds, we were done on that other slide. That was it. Now, of course, if I'm making such a big deal out of this, you've got to understand, or you've got to suspect at least, that there's going to be a difference as we talk about some of the higher earning clients. And indeed there is. And one of the first things we need to do as clients have high income is now we have to start to understand, what sort of business does your client have? What do they do? Are they an SSTB or a non-SSTB? And here, those terms those are short for specified service, trade, or business, or non-specified service, trade, or business. And we've been conditioned since birth, right? Like red, bad, green, good. So that's going to be the case here, right? So first off, what on earth is a specified service, trade, or business? Simply put, it is a business as defined by the Congress as being in one of these categories, things like health, law, accounting. And while I'm not going to go into the nuances of each and every one of these, what I will share with you is, for the most part, they are defined very broadly. For instance, I'll just use health as an example to make my point. If your client came to you and said, hey, I just had to spend $10,000 on surgery for my dog, how much is deductible on my tax return? Well, as much as we may love our dog, and as much as we may consider the dog a part of our family, the tax code does not. It is not a qualified medical expense. However, when we're talking about the fields of health here for this purpose, if your client's a veterinarian, they are going to be in the field of health. So again, this is very broadly defined. Now, here's the good news and the bad news for these individuals. The good news is that if you are a high income individual and you are in one of these businesses, and I'm going to define high income as people who are not only not just not below their phase out, but people who have gone through their phase out range. So you saw the start of those phase outs on the previous slide. It was about $400,000 for joint filers this year, about $200,000 for single filers. For married couples, there's a $100,000 phase out range, so roughly $400,000 to $500,000. For single filers, roughly $200,000 to $250,000 is the phase out range. For high income clients of specified service businesses, it's the kiss of death. The good news is calculating the deduction for those individuals is really easy, really easy. The bad news is it's really easy because it is always $0, right? So it's not a good thing, right? If you are a high income individual and you're in a specified service business, so just going back one slide, you're a financial advisor or a doctor or a lawyer and you make $600,000 a year of taxable income. Well, you're above your phase out range. Your deduction is going to be 0. Period. End of story. And there's nothing I can do. I can't think about wages. I can't think about depreciable profit. None of it matters. If you're a specified service, trade, or business, your deduction is 0 if you're over your phase out range. So already, if you're thinking proactively, as hopefully you are, when we're working with a client who's a high income specified service, trade, or business, there may be a number of ways to think about accomplishing this, but at a global level, there's really only one way to increase their QBI deduction. What is it? Lower their income, right? Like there's nothing else you could do. If their income is high and above the phase out range, it's gone. So the only thing you could do is get it below the phase out range so they get some. Now, how about high-income clients who are not a specified service business? I'm just going to use your client's a widget maker as an example here. Well, there it's more complicated. There, maybe they still get the full QBI deduction. In other words, it's 20% of their business income or their taxable income, whichever is less, right? That's possible. They might get no deduction in certain circumstances, or they might get a partial deduction. So here's the deal. The way we determine that is we look at some attributes of the business and we perform some tests. The way I have explained this for years, and it's a little bit of a corny analogy or example, but I've run across advisors afterwards who go, now I get it. So I'm going to use my sort of very silly example here, but hopefully it illustrates the point. When you have a client who has high income, I want you to imagine that they're on a ship and they're out to sea in the middle of the ocean, right? And as their income gets high and high and high, they fall overboard, right? And their deduction now begins to float away. If they are an individual who is the owner of a specified service business, I guess we could call the ship the SSSTB, right? They would be out in the water and we're running around the boat looking for one of those life rings, right? To throw them and bring that deduction, to save the deduction. We want to save it. But you're running around your SSTB, your specified service trade or business, and there are no life rings. It's gone. There's nothing you can do. No way to save that person who's floating out. No way to save that deduction that's floating off into the wide open ocean. Now, by contrast, if you were on the same ship, but it was a non-specified service, trade, or business, you run around the ship looking for the same life raft, and lo and behold, you can find one. But the size of that ring, the size that the ability to reach out and save, pull back some of that deduction is determined based on either the wages of the business that are paid or the wages and the depreciable property of the business. Effectively, you can see here that second major bullet on the screen has two sub-bullet points. Those are the two tests. We either look at 50% of the wages the business pays or 25% of the wages paid plus 2.5% of the unadjusted basis of depreciable property. If you're wondering, what does that term mean, unadjusted basis of depreciable property? Well, if you buy a building, right? The first year you have the building, it might be worth $1 million, but over time you depreciate it. So 10 years in, your $1 million building might have a basis of, call it $700,000. For purposes of this test, you use the $1 million initial value of the business, okay? Then we just look and we say, which of those two things is higher? And then that is the size of the life ring that we can throw overboard. So if your client had a business that paid $200,000 in wages, and they were a high-income, non-specified service business owner, well, 50% of $200,000 is $100,000. That is the amount, the size of the life raft that I can throw overboard and bring back, save the QBI deduction that would otherwise float away. Now, is it big enough? Well, it depends. What was the original QBI deduction? If the business had a relatively, nominal profit, let's say the business had $50,000 of profit for the year, well, that's a $10,000 QBI deduction. $100,000 more than covers that, right? So it depends upon where your client's profits are. If the business had, let's say, $2 million of profit, $2 million of profit times 20% is $400,000. But your life raft, if they paid $200,000 in wages, is only $100,000 large. You can only save $100,000 of the $400,000 deduction. So that's the way I think about it. And hopefully that's just a visualization of how that would work. And then again, just thinking about how you get to these numbers, if you want to know what the client's wages are, and look at the W-3, ask the CPA, things like that. And then the unadjusted basis of property, I've sort of already given you an analogy, or excuse me, an example there of how that works. Now, you noticed I said, let's talk about income below the phase-out range and then income above the phase-out range. I haven't really gotten into income within those phase-out ranges. I do have a slide here with a simplified calculation on how that works. Here you go. This is what it looks like when you're within the phase-out range. I'm only kidding here a little bit. It's much more complicated. It depends upon whether you're a specified service business or not. Effectively, the way your deduction phases out looks differently. But just know that if you're in the phase-out range, you might get some, right? It's some. Whereas if you're below, you get it all. If you're above, it's going to depend upon the type of business you are. If you're in the middle of the phase-out range, you'll get some. But the curve of how fast that deduction will go away from full before the QBI phase out to zero looks differently. They look very different for those two types of businesses, but it's still a phase out, right? One is exponential, one is more linear. That's all you have to know. All right, so now that's it. That's our discussion of how do we calculate this deduction? That's it. Now you're an expert. You know everything you need to know in terms of how to actually calculate the deduction. So now we're going to talk about how do we get more of this deduction for our clients. My goal is not that you remember every single element of every single strategy we're going to talk about right now. but rather what I want you to have is I want you to begin to build a Rolodex of solutions that if a client comes to you, you go, oh, based on you and your business, your high income and your non-specified, here's the things that we can consider exploring. Right now, again, just as a summary, remember, low income, we're kind of good, right? We don't have to do the same level of planning. High income specified service business, the only way to get more deduction is to lower income. A high income non-specified service business, I have a couple of different levers I can pull. Either I can pull the lever of lowering income, just like a specified service business, so that it no longer matters, right? Like if it no longer matters that whether I have wages or business property because I'm below the income threshold, that's one way to get more potentially. The other way is I could look to manipulate my wages and depreciable property in a way that benefits the business owner. All right, so starting with our Rolodex of solutions, the first thing I want you to think about is there even a way or a potential benefit to separate the taxpayers? Normally speaking, most people file, if they're married, file joint because it saves them money on taxes and it's also easier. It's for the tax preparer, you're only filing one tax return, all of those things, right? However, when we're looking at the QBI deduction, and the quote there, you see there's different numbers. Those are the old phase-out numbers. We've changed over the last few years, but this is the copy of the tax code, if you will, as it was written. So what that shows you is that there's one number for joint filers and one phase-out for everyone else, including those who are married filing separate. So I want you to imagine a scenario where you have one spouse who makes, let's say, $200,000 a year as a sole proprietor, and they are let's say they're a sole proprietor CPA. A CPA would be under our accounting group for specified service business owners. So that would be a specified service business owner. Now, on their own, making $200,000 of business income, if they filed and took their standard deduction, they would get a QBI deduction because they would be a quote-unquote low-income taxpayer by our definition. But what if that same individual was married to someone who had $400,000 of W-2 wages? Or maybe the couple had a significant amount of interest and dividends that they reported jointly, but that could be reported separately on another spouse's tax return, right? In those instances, you could consider filing separate returns. Now, sometimes this is a win. Sometimes it's not, but it's worth exploring. And what I share with advisors is, a lot of times we just think like, well, the CPA is going to take care of this when they file the tax return. They'll let them know if they should file separate. No, honestly, that's probably not going to happen. In the height of tax season, very few CPAs are going to go, you know what? The income that you have here sort of perfectly aligns to this other strategy that's going to require me to file an extra tax. It just doesn't happen, right? It's too much going on. This is the type of projections or planning that need to be done outside generally of tax season so that when you get into it, you know what you're going to actually be doing. What you're looking for this is a high income specified service business owner client who has income as high as possible, but not so high as to phase themselves out, right? If that same CPA made $400,000 a year from their practice, well, their own income phases them out, and it doesn't matter if you file separate. So you want as high as possible so that you can get the biggest QBI deduction possible, but not so high as to phase yourself out. And then you need the other spouse with income that is high enough to phase out the other spouse's QBI deduction, but not so high on their own that it's not worth filing separate, that their income is so high that it loses all benefits. So it is, in fairness, like you're looking for the Goldilocks situation, right? Income not too big, not too small, but where it's there, it's worth exploring. Another thing we could do is we could look at moving people from salaried employees to independent contractors. Now, again, not every client is going to be able to do this, but think about it this way. If you're an employee, your wages are not eligible for the QBI deduction. If you are a sole proprietor, it's your business. You might be eligible for that. Maybe you have a client who works part-time for a business owner, or who has a full-time job but just says, hey, you know what? I would like to go to this business owner and propose a change in the way that we do business with one another. Instead of being your in-house marketer as a salaried employee, I want to become an independent contractor and I will perform services to your business. And by the way, in the right situation, you can find a win-win for the business owner and for the employee. Because maybe the business owner doesn't care. Maybe they're happy to pay, instead of $100,000 in wages and $20,000 of health insurance benefits and $10,000 of employment taxes, that's $130,000. Maybe they're happy to pay $120,000 or $125,000 for the same services. And now your client, yes, they have to pick up some of those expenses, but they may get a $20,000 deduction each year for their business profits. So it can be a win-win. We can go from a client who is an employee to a sole proprietor. We could actually go it the other way, right? We could look to say, we want to take outside labor and bring it into the business. And this is, again, these are types of things, now that we have a good sense that the QBI deduction will stick around for the foreseeable future, we should begin to investigate much more seriously. I understand why maybe last year or even the year before that, business owners were loath to implement changes that might have long-lasting repercussions, but for only a year or two worth of tax benefit. But now it looks like this is going to be around for the foreseeable future. What if we look to bring more people inside the business as employees? And here, your client situation is a high-income, non-specified service business owner. So think back. High income, all right, they're phasing out. Their deduction is floating out to sea, but they're not a specified service business owner. So I can run around my ship looking for that life raft, right? And I can find it and throw it overboard and save that deduction and bring it back. And that can include wages. So I'm going to share with you an example that is not, the numbers aren't exact, but this is a very similar situation to a real life scenario I had with a client years ago, right after the QBI deduction came out. And we were able to change the way they structured their business so as to get them a six-figure deduction each and every year, where otherwise they would have had none. And again, I've changed the numbers in the business, but this is effectively what happened. So the business owner had $600,000 of net profits and selling widgets. So they're a high income, they're above the phase-out range, but non-specified service business owner. Now on $600,000 of income, 20% times $600,000 of business profits, that's $120,000. That's their sort of maximum potential QBI deduction, right? That's their ceiling. And this particular business owner had a bunch of ICs, independent contractors, working for them, and they paid about $325,000 a year to those individuals. They had no wages paid and no depreciable property. Now, if that's the case, we're high income, deduction floats out, we run around the ship, we look, and even though it's a non-specified service business, there's no life raft, there's no wages paid, there's no depreciable property. We don't have anything. So what could we do? Well, one is we could lower their business income, but we don't want to lower their profits, right? And maybe they don't want to do a retirement plan, or maybe they already have one in place and there's just no more room. But what if we looked at the other side? What if we looked to take that outside labor, to say, no more independent contractors. Look, either you come work for us as an employee, or or we're going to find someone else to do that. Well, that is what happened. And let's just imagine that after paying wages of $255,000 of salary, plus health insurance, plus the employment taxes like Social Security and FICA, let's imagine that we got back to the same $600,000 of profit. Well, now my potential QBI deduction is still $120,000, right? That hasn't changed. Still 20% times $600,000. But now I've got $255,000 of wages that are paid. Half of $255,000 is $127,500. When I'm looking around my ship, I've got a life raft that can support $127,500. I throw it overboard, and lo and behold, it's big enough to bring back the entire deduction because $120,000 is less than 50% of the wages paid. Imagine getting a $120,000 deduction every year when you might have gotten none. So that can be super valuable as well. I'll move through the next slide a little bit quicker, but just actually not this one. This one we'll pause on for a moment. Is there an opportunity here to take non-salary paying entities and move them to salary paying entities? Like for instance, take a sole proprietorship or even a partnership and make it a corporation, an S corporation, so that you can pay yourself a salary. Because in the last example we looked at, right, it was great. We saved the deduction by hiring those people as employees instead of having them work for us as independent contractors. That was great. But if I was that business owner and I didn't already spend money on those people, like I didn't need that labor, I'm not going to go out and spend $300,000 on hiring new people so that I can get a deduction for $120,000, right? Like that doesn't make sense. To spend $300,000 to get a deduction for 120 that might save me 60 or so on taxes, that seems very silly. But what if I have a business that I could pay myself, but I don't? Here's an example, a sole proprietor who has $750,000 of net profits. You might say, well, shouldn't they have an S corp? Well, maybe they just never wanted to bother with it. They just wanted things to be simple. Well, 20% of $750,000 is $150,000 of potential QBI deduction. That's pretty big, right? But no wages, no depreciable property paid. There's no QBI deduction. So what could we do? Well, we could change the business into an S corporation. And let's just say we paid our owners $300,000 of salary. I'm ignoring employment taxes or things like that here. Let's just say we got back to the same then. We got back to $450,000 of net profit. Well, if I had $450,000 of net profit, 90,000 is 20% times 450. I've got a $90,000 potential QBI deduction here. And if the business owner paid themselves $300,000, well, 50% of that is 150. It's more than enough to cover my $90,000 potential QBI deduction, right? Well, here's the deal. Some of you are probably going, hey, that's great. We just got a $90,000 deduction. There are probably others on the call with us today who are going, well, that's great, but Jeff, you actually overdid it, right? You kind of paid them too much because you paid so much in salary that their profit was lower and they ended up with more salary than they needed. Like, couldn't you have paid a little bit less in salary to have a little bit more profit, but still enough salary to? And the answer is yes, you could. And you could sort of guess and check your way to like an ideal salary, if you will, an ideal target salary. Or I could just have another slide that has a number for you to multiply by. And it's 28.57142 and change. You take the profits of the business before the owner's salary, multiply it by that number, which happens to equal 2/7. That's where that comes from. And the result is the perfect salary for QBI deduction purposes. So kind of going back here to our numbers, $750,000. Let's multiply that by 28.57. That gets us a salary of $214,000. It leaves us with $535,000 and change of net profit. 20% of that is $107,000 and change. There's a couple dollars difference here because I rounded, and that's it, right? They equal. Now I have a QBI deduction that is perfectly saved. The size of the deduction floating out to sea and my life raft are exactly the same because I use that 28.57% number. Now, in fairness here, right, like it is fair to say that if you are asked by the IRS under audit, and I know you all are not representing clients on audit, at least most of you, but you might, you work with clients, you certainly don't want them to be in that situation. If a client turned to the auditor and the auditor said, please explain to me how you arrived at your salary. How do you determine that this is a reasonable salary? And the client looked and said, oh, well, it was 28.57 of my business profit, so it gave me the highest QBI deduction. That is not going to fly with the IRS agent, right? S corporation salaries are a hot button issue. They have to be reasonable. But when I say this is the perfect salary, I mean, you got to know what you're aiming for in the first place, right? In this example, we'd aim for $214,000 to be a reasonable salary for the client. And then you begin to construct your narrative, right? If that's less than you think the client would make as a reasonable salary, you start to make arguments for that. Like, well, they don't work 40 hours a week anymore. They've got a lot of other people. If it's higher, you say, well, my client has a master's and they have years of experience. Like, there are all these things that we do to craft the narrative. Reasonable is not a number, right? Like, it's a very gray area with some number being like, yep, that is definitely reasonable. And as we go out and we expand, things become maybe a little bit less and less and less reasonable. But if you don't know what your target is, we never know what we're trying to craft as a narrative to begin with. All right, in some cases, it may change actually to go from an S corporation to an LLC, particularly if income is relatively close. If you think like, well, my client, they've got to have $150,000 of wages for a reasonable salary, and there's only $170,000 of profit in the business, you probably actually want to go away from the S corp and go back to a partnership or a sole proprietorship, because in the S corporation, only the profits are eligible. Whereas with a partnership or a sole proprietorship, all of that income, other than guaranteed payments in a partnership, would be eligible for the same deduction. All right, I'm going to move us forward to retirement plans here. And I want to share the next 4 or 5 slides, I think, are some of the most impactful for advisors. Because when we think about our day-to-day work of what we do with clients, we work a lot with business owners looking at retirement planning, et cetera. Again, if you've paid attention to nothing else over the last hour or so, the next 4 or 5 slides will give you some key takeaways to think about with clients to help them make good choices. We've always said to clients, you know, look at retirement planning, implement a retirement plan for your business that will help you achieve your long-term goals, et cetera. But I don't think clients really get how impactful that can be, especially if they are higher income where they're beginning to see some phase out of their QBI deduction. Now, I'm going to ask you a question. Obviously, you can't all answer me, but like, what's the highest tax rate right now? Now, your answer is, the chances are you're saying something like 37%. At least that's the answer most people will give. That is the highest tax bracket right now. It's not the highest tax rate. In fact, the QBI deduction, you know, some people are familiar with the Social Security tax torpedo. There is a somewhat analogous effect with individuals as they go through a QBI deduction phase-out range where they can have a heightened or an accelerated marginal tax rate. And this year, that marginal tax rate can equal almost 51% federally alone. I'm going to give you an example to illustrate what I'm talking about here. So let's imagine your client has $524,600 of income. Now, that's a very specific number because I'm going to create a Goldilocks example for you. After taking a $30,000 standard deduction, they would have $494,600 of taxable income, right, before any QBI deduction. Well, that is exactly the top of their phase-out range. That is the last dollar that they had phased out the last dollar of their QBI deduction. Take my word for it, this year, that would result in a tax bill of about $112,000, okay? Just take my word for it. I've done the calculation for you. Absent any self-employment taxes, just ordinary income tax, that's a $112,000 tax bill on roughly $495,000 of taxable income. But now, let's imagine that I had the same client, and I started with the same $525,000 roughly. I took my same $30,000 standard deduction, but I somehow also lowered income by another $100,000. Call it a 401k that I make contributions for the owner and their spouse, or a defined benefit plan that I put in, or maybe even a giant charitable contribution to a donor advised fund. It really doesn't matter here. I'm lowering taxable income before the QBI deduction by $100,000. If I do that, now that income amount is $394,600, which is the very bottom of the phase-out range, which means It no longer matters whether I am a specified service business, a non-specified service business. Doesn't matter what wages or depreciable property my business has or pays. None of that matters. I get 20% times that amount. That is $78,920, or another $79,000 deduction in addition to the $100,000 deduction I already got. In other words, for every $1 I actually do something to get a deduction for, I'm going to get a bonus 80 cents in that phase out range. The net result here is after taking the $100,000 deduction for whatever I do, again, retirement contribution, charitable contribution, etc., and I factor in the increase in the QBI deduction I get, there's a net difference in, or a net tax bill of $61,457. Go back one slide, $112,000 of taxable income, excuse me, of taxes before. I put $100,000 into a retirement plan or something like that, and now I'm down to $61,500 roughly. That is a $50,000 plus lowering of that federal income tax bill on $100,000 of income. Or go the other way. Think about it this way. As your client's income rises through that phase out range, it's going to cost them another $50,000 plus in federal taxes. Add in state taxes, and it can be close to 60% in some areas. In some situations, the best advice to a client is, hey, take it easy. Don't work so darn hard. You could work 20% less over the course of the year, and your difference in take home would be like $40,000. Like at some point, the client goes, okay, I'm working to make the next $100,000 so that 60 of it could go to taxes? That doesn't make any sense, right? Sometimes it's just take it easy, Mr. and Mrs. Smith. Now, we think about the next element of retirement plans. This is something that I uncovered shortly after this deduction was put out there, and I coined this issue the so-called deduction-reduction problem. And effectively what this is a scenario where clients may only be getting a deduction for a portion of their retirement contributions. The text you see here is right from the regulations, but what it means is, and you don't have to read all of this, but effectively, think of it this way. Whatever deductions a person has that are attributable to the business, they will lower that profit of the business that can be used for QBI deduction purposes, even if it's not actually on the business's income tax return. And so a good example of this would be, let's say your client is a partner in a partnership. The partnership kicks off their income. Your client will take their retirement deduction for a self-employed retirement plan on their 1040. But even if you do that, you still have to factor in that reduction in their net business profits. And effectively, this can lead to an 80% deduction for retirement contributions. I'm going to give you an example. I'll use an S corporation because it's a little bit easier to illustrate. But the same principle applies with sole proprietorships and also applies with partnerships. I want you to imagine that your client, Robin, owned 100% of the Woods, Inc., an S corporation. And they paid themselves an $80,000 salary, and they had $90,000 of profit before their retirement plan contribution. All right? $80,000 was what the CPA said they've got to pay themselves to be reasonable salary. So the client did that. Now, what's the maximum, SEP contribution here? Or excuse me, I should say, what's the QBI deduction here? Well, before we do anything, it's $18,000, right? Like that is the potential deduction on $90,000 of profits. 20% times the profit, $18,000. But now let's suppose that Robin makes a QBI deduction, excuse me, a SEP IRA contribution, which Robin does each and every year. The max deduction there is 25% times wages paid. Well, Robin paid, Robin received $20,000 of, excuse me, $80,000 of wages. 25% of that is $20,000. That would be the SEP contribution deduction. But now if I make the SEP contribution, my profit is not $90,000, it's $70,000. And the QBI deduction on $70,000 of profit isn't $18,000, it's $14,000. So effectively, before I made the SEP contribution, I had $18,000 of net deductions between my my QBI deduction and my SEP deduction. After I put $20,000 in, I have $34,000 of deductions. So effectively, after making $20,000 of SEP contributions, I increased my deductions by $16,000. Now, what happens if the very next day I change my mind and I take a $20,000 distribution from my SEP IRA? Am I taxed on the $16,000 and I've got $4,000 of non-deductible? No, because as far as the IRS is concerned, you got a $20,000 deduction for your SEP. You just lowered your QBI deduction. But I say, who cares? At the end of the day, I put $20,000 into something and I only got a $16,000 deduction. So what can you do in these situations? Well, first off, I've got a chart for you here. In order for that to make sense, your client has to be in a substantially higher tax rate now than they would be later on. Like that difference between current and future tax rate has to be magnified. Otherwise, it doesn't make sense. And you should consider things like maybe doing a solo 401k if possible. And instead of doing deductible contributions from the business, maybe do like the mega backdoor Roth and have more of the money going into the plan coming from the employee side, because the employee side doesn't reduce the profits of the business, right? Like your client can make their, $20,000 or so salary deferral and then maybe put another 50 or so in as a non-deductible contribution from their salary, and everything else can be profit of the business. This way they maximize their QBI deduction. Now, it could actually go the other way too. In some cases, you might actually need to generate income. This is kind of the opposite of deduction reduction, something I call deduction production. In this particular instance, you're looking for clients who have taxable income that is lower than their business profit. Taxable income that's lower than their business profit. So an example here, let's say your client has $150,000 of profit from a CPA sole proprietorship that they operate. Well, 20% times 150 is $30,000, right? That would be their potential deduction. But let's say they didn't have any other income. And let's say they took a $30,000 standard deduction for them and their spouse. That means their taxable income is $120,000, right? So $120,000 is their taxable income. Their business income is $150,000. Remember, we take 20% on the lesser of those two. So in our example here, it would be 20% times $120,000. Now, if I had $150,000 of taxable income, I could actually increase my QBI deduction because here I'm limited by taxable income. What if I did a $30,000 Roth conversion to take my $120,000 of income, taxable income, and raise it up to my business income? Well, now for every dollar I convert, I'm actually getting a little bit more QBI deduction. So in this example, right, for every dollar we would convert, we'd actually only pay tax on 80 cents. It's the opposite of deduction reduction. It's a wonderful way to help clients pay less for a Roth conversion. And it's really easy to spot. I know this is a lot of stuff and this can get really in the weeds, but here you just got to look at two numbers on the tax return. Look at their business profit and see, is that more than the number on the taxable income line? If the answer is yes, this is something to look at. It's a very simple if this then that sort of thought process. All right, and then finally here as we wrap up, and then I'll take maybe a couple of questions super quick, is think about bunching charitable deductions. Again, there is no difference in the example I gave you before of that client, whether they put $100,000 into a retirement plan like a pension plan, or they had made a $100,000 contribution to a donor advised fund. Lowering the income by $100,000 would have saved them $60,000 in taxes. Mr. and Mrs. Smith, do you want to give $100,000 to charity but really only spend 40 and have the other 60 come from the IRS? Well, here's how to do it, right? Things like that. We could look at changing partnership payments. Be mindful of guaranteed partnership payments. I have an example here for you about how you might shift a partnership from guaranteed payments to something that is functions without them because, again, guaranteed payments are not eligible for this deduction. So there's an example here for you. Obviously, you got to look at more than just taxes. Be aware of what that does to the partnership agreement, et cetera. We could look at transferring business into trusts for each beneficiary. Each trust could get its own little bit of QBI exemption. Remember that phase out range is separate for every taxpayer, including a trust or an estate. So if your client has, let's say, 5 grandkids, they could create, or 5 children, they could create a trust for each of those kids. And even if the kids are above the phase out range, they could fund a trust with just enough of their business interest so that the income that came out to the trust would be low enough that the trust would qualify for the deduction. And then after the trust gets the deduction, it can pass it on to the children after the trust pays taxes. There's lots of other things like that in the works here. And little things, even like shifting income from a business owner to a child. Put a child on the payroll if you can justify it. Pay them. This year you can pay a child up to $15,000 and they won't have any income taxes because it's earned income. Again, you have to justify it, but think about that. That can be $15,000 of tax-free income to the child, way better than allowance, and it can help reduce the business owner's income to maybe get below the phase out. I mean, it could be a win-win-win. Look at portfolio income. Are there ways to minimize that so that we're not having income? I mean, there's all things to look at on an ongoing basis. But at the end of the day, the key point here is to remember what are the key things for my client that I need to look at in order to determine whether or not there are strategies I can bring to bear. At a high level, it's this. If they're low income, we're good. If they're high income, specified service business, you have one thing you can do: lower income. How you choose to do that, retirement contributions, charitable contributions, more depreciation, whatever it is, that's your choice. But you got to lower income. It's the only way to get more. For higher income individuals, we can start by looking at the same salary reducing methods, but also at the same time looking at ways to manipulate wages and depreciable property. Can I hire independent contractors? Can I hire myself? Can I adjust wages to make this work? Those are the sorts of things you can do. And again, I think just about everything I shared with you today can be modeled within the Holistiplan system. So you can really do some great high-level projections for clients and show them the value that you can bring. This is one of those more nuanced and challenging areas for advisors for obvious reasons. It is complicated, but again, the rewards, in my opinion, are worth it. 20% of a potentially big number is a big number, and it can be a big number year after year after year. Think about that example I shared with you where we got a 6-figure deduction each year from nowhere. That is someone who will never, ever, ever leave. It doesn't matter what investment performance looks like. All right. I know there were a bunch of questions. I tried to answer most of them as we went through, and without actually calling out the question. I've been scrolling through here, but I will answer one more here. How do you split itemized deductions of a married couple that file separately? In that particular instance, first off, it's going to depend upon whether you're community property state or not, because community property states, as many of you know, you're going to have to apportion income between the spouses no matter what. There's not much you can do. For itemized deductions, you look at it by person, who paid what, and if certain things are shared, then you split them jointly. And then here we have, so if you're paying yourself a reasonable compensation, how does this change QBI, or does it? Paying yourself a reasonable compensation helps when you're a high-income, non-specified service business owner, or potentially does, because you can go from having no salary and no wages to use for your wage test to having wages. So it may not change your profit, right? You may just change things from one, or at the end of the day, what you're looking is to take what is $0 of QBI deduction and make it something, right? And there's the challenge here, and I'll close with this, and then Roger and I can talk about what's going to happen the rest of this year probably. And it's simply this, right? There's no simple way to say everyone in this situation always does this, everyone in this situation always does that. Because I shared with you an example, not too long ago, of where making a big retirement contribution might be bad because you might only get a deduction for 80 cents of the dollar. Well, that's not good. But what if you're above the phase out range and you're getting nothing? Well, then getting 80 cents of the dollar is not so bad, right? So it really is a client specific situation. It's why we can't just dive into the strategies. We have to go through the calculation first, because ultimately you need to understand how your specific client's deduction is going to be calculated so that you can figure out which of those strategies in the Rolodex of solutions we talked about might make sense for them. All right, Roger, let's, oh, sorry, Laura. I see
Hey,
Laura
Jeff.
coming back on, and Roger. Everybody's here. All my friends are here.
No, that was great. Thank you so much, Jeff. That was awesome. That was awesome. So this next topic is going to be between Jeff and Roger, and it's going to be about 2025 policy updates. And I just wanted to do a quick intro. So Roger Pine is our CEO and the co-founder of Holistiplan. He was a financial advisor for 10 years, and he really is the brains behind the entire software. So I'll leave it up to you two.
Sounds good. Thanks, Laura. Jeff, this was a last minute addition. I appreciate you offering to do this with a little bit of urging from our side, because, it's 2025, the election happened. And
wait, there was an election?
Yeah, it was in the news a little bit. Yeah. And I tell you what, like, I have such a weird, as someone who has to sit there and like code this stuff into software, it's hard for me to think of this stuff from a policy perspective. It's purely what's going to change and how bad is my life going to be recoding it all, which is like a weird way to look at this, because like, I know the implications are enormous for a lot of people and there's opinions and all that stuff. And we're not going to get into like the good and bad of the policy. It's more just like from the perspective of financial advisors, what do the tea leaves show us at the moment about what may or may not happen? Because we are starting to get some indications. Timing wise would be really interesting to hear too. Please tell me I'm not writing this code Christmas Eve or New Year's Eve at the end of the year. You remember that one year when they put in the patch like after December 31st? What year was that?
Every year. That's every year.
Well, there was one. It was before. But it was before Holistiplan, so I didn't have to code that. But like we have had.
Yeah, that was 2012. The American Taxpayer Relief Act of 2012 was passed on January 2nd, 2013.
Exactly, and then we did have one during COVID where in March there was some retroactive stuff that happened.
Yep.
And so that one we did have to code. Anyway, what are your thoughts? So like state of play, where are we as far as, of course, Tax Cuts and Jobs Act is meant to expire at the end of this year.
Yep.
What do you see happening between now and the end of the year to either extend that? What's going to change? How would you like to set this up?
Yeah, I mean, that's like 17 questions there. So
yes,
let's go one by one.
It is.
All right. So the first one I would say is, like, we're going to get a tax bill, right? And in all likelihood, this is going to happen, I believe, relatively quickly. Roger, I don't like to guarantee anything when it comes to Washington because it is a weird place. But I would be shocked if you and I are sitting here at the last moments of the holiday season, fumbling through legislation. I think we'll probably get things done sometime in the first half of this year, potentially even before the end of the first quarter, though. I think probably first half is still a good target right now. I would say if I were
before the
betting
summer recess,
yeah, if I was a betting man, I'd say May or June is when we see this. But it wouldn't surprise me to happen sooner. Look, here's the deal. At the end of the day, and you sort of set this up nicely, Roger. Like, we're not talking about good or bad or whatnot. Everybody's got different opinions on policy. But if we're being objective as advisors, whether you're happy with the results politically or you hate the results politically, our lives could not be any easier than they are right now. Right? Like, this was, from an advisor perspective, the absolute best case scenario from a will my life be a living you-know-what throughout the rest of this year. Because we do have a single party in control. And the single party that happens to be in control is the party that wrote the law that exists right now. So in all likelihood, we're going to see wholesale extensions of the Tax Cut and Jobs Act, right? Like, that is going to happen here at some point at the beginning of this year. Now, will be probably some changes. We'll talk about that in a second. But the key point here is, You know, Republicans have the White House, they have the House of Representatives, and they have a simple majority in the Senate, which allows them to pass reconciliation bills. Unlike just about everything else, we don't need 60 votes in the Senate to actually get this done. So we're probably not going to see anything big on gun control in the next 4 years or 2 years, because you're not going to get, you know, enough Democrats to get to 60 in the Senate to get to cloture. You're not going to get to a vote. But you can do it with fiscal related bills, and that's where we saw 2010's Affordable Care Act. It's where we saw 2017's Tax Cut and Jobs Act. It's where we saw the Inflation Reduction Act. The big tax policy legislation is almost always done by one party whenever they're in power. This is just a Republican's turn. And again, they're going to use that to keep the things that are in place today. Had Democrats won, right, we probably would have had a tax bill sometime, you know, before the very end of the year, because they would have gotten together, just like I think Republicans will do, and they would have passed something under reconciliation. So it wouldn't have been a scenario where we were in next year before we had the rules, but the rules that would have been in place would have been a lot different than what exists now, right? Like, Roger, you would have been coding for a very, very, very long time.
Yep.
Because there just would have been a lot more changes. Now, if there had been a split, our lives would have been miserable, because there were a lot of people projecting that if there had been some shared control, any way of shared control, you know, Democrats had won just one of the presidency, the House or the Senate, that we would have been in a scenario where it would have been super late in the year this year, or potentially even well into 2026 before they would have settled on tax policy for 2026, which would have been a nightmare for advisors. That law you referenced, Roger, the one that changed at the beginning of the next year, a lot of people may not recall, but that was also going to be a big estate tax change. We were going from a $5 million exemption back down to a $1 million exemption.
Yep.
And so, you know, there were wealthy people at the end of the year with advisors who had no idea what to do. They're like, well, it looks like Congress might do this, but they haven't done it yet. It could be 1 million. Do you really want to risk losing 4? And so people gave away a lot of money right at the end of the year. And then on January 2nd, the following year, the IRS said, nope, or Congress said, nope, don't worry about it. Everybody can still have a $5 million exemption. And then a lot of those really rich people spent a lot of their own money trying to undo the gifts that they just did. They tried to say, nope, I was just kidding. Wasn't really a gift. They called it rescission, right? It was a fancy word for a take back, right? An undo button for a gift. And some of it worked, some of it didn't, but it was a nightmare for planners. We're not going to have to deal with that. We're going to get something early this year. Now, I say first half of the year because there's still some things to be worked out. You asked, you know, what's likely to change, what's likely to stay the same. Look, I better say the QBI deduction is going to be around after the last hour we spent together, right? So QBI deduction is likely going to be here. The tax brackets will likely look, if not identical, pretty darn near identical. The standard deduction would stay. We're going to probably still not have to deal with miscellaneous itemized deductions.
Right.
The
fees limitation not happening, exemptions not coming back.
Say that again?
Sorry, personal exemptions not coming back.
Personal exemption still gone. Estate tax exemption still doubled. You know, like all of the child tax credit will be more than 1,000. Right now it's 2,000. There's talks about potentially raising that even further. But that's the stuff that is still very unclear at this point, right? Is the things that there's support in the Republican Party, either in mass or by some powerful group of individuals, or in the case of the president, one individual, right? Like Donald Trump has repeatedly said, President Trump has said, he wants tax tips and Social Security and overtime to be tax-free. Those are all expensive provisions, right? Those are all, now, the good news is if any of those happen, it might change our projections. It probably doesn't change a whole lot of planning, if you will. Right, maybe some Roth conversion planning if Social Security is made tax-free or things like that, but it's not like we've got to rush to do anything. But those are things that all cost money. The SALT cap, that is probably the area of the biggest contention because there's intra-party fighting. You've got some Republicans saying, I have to see this raised. I live in a largely blue state, but I'm in a red pocket. And if you don't raise the SALT cap, I'm going to get run out. I'm not going to get reelected, which is actually what happened after the Tax Cut and Jobs Act, right? There was a flip in Congress after that happened, right? Republicans only had 2 years of control totally last time. we are likely to see an increase. Now, is that a doubling? Is it raise it to 50 for single filers and 100,000 for joint filers? I don't know. They're still fighting about that because on the other side, you've got deficit hawks on the Republican Party who say, we are going to explode the debt even more than it is, and we shouldn't be doing that. And so right now, it's just about coming to terms within their own party. But the president has a lot of political power at this point. He is a driving force in what the Republican Party does. And if people don't kind of get on, it's very clear. Like he has a lot of political capital. He's not afraid to use it at this point. And so I do think you're going to see a lot of the things that he wants either enacted or, there's going to be some element of it. And we are likely to see those sorts of changes. One last one would be the child tax credit. You heard Vice President Vance, J.D. Vance on the trail say he wants a $5,000 credit, per eligible child. Well, that's great, but that is also a really, really expensive provision. I'm not saying it shouldn't be there, but objectively, it costs a lot of money. The question is going to be, how quickly do Republican deficit hawks and Republicans on the SALT side and on the, hey, let's make Social Security tax-free side and all that sort of stuff, how quickly can they meet in the middle? The quicker they do that, the quicker we will have a tax bill, and we will be on our next webinar all together discussing it. And Roger, you and I will probably have many a nights together, pinging back and forth on Slack going, is this how this formula works? Nope, actually, no, it's like this. And it'll be all coded into Holistiplan by the time people wake up.
Perfect. Two things. You said it real quick, but I want to make sure we highlight this. In your view, estate tax likely to stay with a higher limits? Do you see that coming down at all?
I don't think there's
I've
any
seen a lot
chance
of
that goes
movement around
down.
that. Yeah. Okay.
Yeah.
I always say there's a lot of millionaires in Congress, and a lot of their donors are millionaires, and but
and they just don't like the party in power just does not like the estate tax. I think getting rid of it altogether is too politically untenable. People will just say, you gave it. See, look, we told you were giving everything away to the, to the millionaires and billionaires of the world. But keeping it high, I think that's, if it was any lower, I would say I'd eat my hat, but I have no hat here. So
there we go. I see stuff about the carried interest provision, which I'll admit I don't understand. Is that something that advisors need to worry about, or is that so niche that don't worry about it? Because I know that was one of the things that they wanted to actually crack down on that in the proposals that the White House brought to Congress.
Yeah, it's ironic that the two provisions that the White House has maybe championed to say like, hey, we're going to save some money, in addition to all the DOGE initiatives. I think the ultimate here is, right, do you go, well, we saved all this money through DOGE, we're going to give it back to the people through tax cuts. I think that is ultimately where some of this is headed. But from a, hey, we'll also do some things to increase taxes, the carried interest loophole and some sports breaks for, some tax breaks
stadiums.
for sports owners. Yeah. Basically right now you can sort of amortize the cost of, buying your team over a very short period of time, which results in massive deductions for these individuals, even though these are highly profitable businesses. Effectively, the cost of the business is allocated mostly to contracts which expire. And so that was the argument and the basis for it. But it doesn't really match reality, right? Like sports franchises don't depreciate over the time. They tend to appreciate, if anything. So that is one change. And the carried interest loopholes, the other, you said, does that really impact advisors? It does if they have clients who are in that situation, and it does for like money managers who are profiting or earn their keep that way. Effectively, what the carried interest loophole is you can earn your earned living by getting a piece of, let's say, like the gains or something as it's in there, and instead of that being taxed as ordinary income, even because you're working for that, that's your pay, it becomes a capital gain, right? That is a very lay definition of what's going on there. And the reality is, if it's your earnings, you probably, like the same way, Roger, if you decided to to give somebody property instead of giving them a wage, it doesn't matter. It's for their work, right? They would still be taxing it as ordinary income, at least on what was paid out to them. So that is something that's been proposed. But candidly, Roger, that was proposed.
Yeah, I've heard about it for years.
Yeah, it's always been proposed. both of those groups, the sports owners and the people who benefit from carried interest, have a lot of money and give a lot of money. So I'm not
Yeah.
going to say it's not going to happen. You know, maybe it's a very populist thing to do and the president can tout that going forward, but he's going to have a lot of unhappy donors. Maybe he doesn't care. He's not going to run again. But maybe, maybe he does. And ultimately, this is just, putting it out. I would say too early to tell whether those things will occur. But for most clients and most advisors, those are not really the big things. It's why I go back to, again, whether you're happy politically or not about that, from making our lives as simple as possible and giving us the break we probably deserve as advisors after the last decade or so of constant barrage of changes in the law between Tax Cut and Jobs Act and Secure Act 2 and Paycheck Protection Program and everything else that happened. We probably have it as easy as we could as advisors. Doesn't mean it's easy. Just means it's as easy as it could. It's all relative.
So Jeff, if you're running a projection for your own clients right now, within Holistiplan, by the way, in our own scenario analysis screen, you have a toggle that says in 2026, the tax laws sunset or they don't. And I know we're talking probabilities here, but
yeah, 100%. There is zero chance, Roger, unless a client tells me, run the scenario assuming Congress doesn't.
Otherwise, you're running it assuming no sunset. Yeah.
100%. Yeah. I think at this point, it is. I understand somebody could say, well, it's more conservative because most people will have higher taxes if things go away. But at some point, you got to look at reality and say that is just, it is possible, but it is highly unlikely. What I would say is, as advisors, we typically have our baseline scenario and then our kind of what ifs, right? Whatever you want to call that in your world, right? It's like, well, here's what happens if my client lives to 95, but what if they die at 60? Like, what does that look like? Or what if they get into a long-term care event? What if the baseline scenario should be the Tax Cut and Jobs Act provisions are extended, and the what if is something weird happens and it's not.
Okay, that makes sense. Okay, final question. So how would you advise an advisor who wants to keep up with this stuff to, what should they be watching for? What are the news sources or the think tanks that you would recommend? Obviously, subscribe to everything Jeff's saying out there, and we're going to do our best to try to make sure we're on the pulse of it. But if you're an advisor who wants to be on top of things, if you want to point your clients to something so you look informed, what sources do you recommend people look at and monitor?
Well, I think the first thing I would do is I would tell everybody, like, just chill. Like, it's good to follow what's going on, but especially in the run-up to these types of pieces of legislation, there's a lot of trial balloons that are put out there. There's a lot of ideas that, like, oh, people may recall that up until very close to the Tax Cut and Jobs Act, one of the ways they were going to try and pay for more of that bill or stuff more tax cuts in was by raising more revenue via Rothification for everyone. We have that new provision next year where high-income individuals who are making catch-up contributions can only make them to Roths. That is like the first foray into what Republicans, by the way, were trying to do back in 2017. Not the other way around. Republicans were trying to say high-income individuals, only Roth, and it was very politically unpopular. So at the end, the president said, nope, we're not touching your retirement accounts. We're going to leave them as is. But people went nuts about this. Like, oh my God, what is it? And at the end of the day, it didn't happen. So I'd say to everyone first, like, chill. Let's see where things go. Let's see draft legislation first. This is going to be a process. It's going to go through committee. It's going to get marked up. Like, things are going to happen. Don't rush to judgment about what you hear in the news. Now, having said that, it's good to be aware because clients have questions about that sort of stuff. And so where do you go? Well, the very first thing is I'd say, Roger, I'm lucky, right? I used to both meet with clients on a day in and day out basis and also try to keep up with this. I don't do that anymore, and I don't know that I could have done that for much longer because at some point you have to sleep, right? I mean, there's only so many hours in the day. So I don't expect most advisors to go through the legislation in the same way. Like, one thing you could do, you can go to the source, right? Like, go read the proposed regulation, read the proposed legislation. Candidly, I don't think most advisors should do that, right? Like, maybe I'm a little bit biased because that's kind of my job, but the whole point is like, you don't need to, you should be spending your time where it is best effective. And when we look at revenue for an advisory firm, the number one predictor of revenue that an advisor can bring in is how much time are you spending with your clients, right? It's not, you know, what do you, how much time have you spent in the weeds and it's how much time are you spending with clients? Now, obviously, when you're with clients, you got to be productive and know what you're doing. But that's where you go to your trusted sources. And again, perhaps a little bit self-promotional, but come to a Holistiplan webinar on the topic. You know, if there's a new tax law, Roger, I'll be, you know, tweeting about it the days that it happened, the night that it happens. There'll be a webinar and I'll have an obnoxiously long article on kitsis.com the next day, you know, saying here's a breakdown of everything. Find who those people are for you. Doesn't have to be me. There's lots of wonderful, you know, whether it be Bloomberg or, you know, whatever resources you want to go to, you kind of have your people or your groups, your organizations for X, you leverage those things, right? And then repetition, because anytime there's a lot of changes, it's just a lot. Like it's just a lot to take in a short amount of time. You've got to do it twice, 3 times. Like I don't read a tax bill once. I do it once. I go through it and make my little notations and tweet storms and whatnot. And then I probably read it another 2 to 3 times in the next week or so, just to make sure that I'm really there. Again, I don't think everybody needs to go to the code, but find your source. And when it happens, the first thing you want to do is your bookmarks, right? Like, okay, there's something on this. I have a client who's in that situation. I have something on this. You can always go back and find the details, but you just want to surface those bigger planning issues first, right? Like who is affected, how are they affected, and then you can go back and figure out exactly what to do afterwards, but just starting your action plan of how do I begin to digest such a significant change? Because even if everything stays the same, it's still news for clients and they still are going to want to know about that.
Yeah. Yeah. You know, what's funny is like what you were saying should resonate with advisors because it's the advice we give to clients about investments. You know, like you can get all worked up about what the Italian National Bank did with such and such and such, or you can just remember we're in this for the long run, blah, 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 blah. And like the same can be true for taxes. Like there's a lot of things you cannot impact. And there's a lot of things that we're just gonna have to wait and see. We have a good idea of where the probabilities are, which is the same as the way how we look at investments. Like the most probable outcome over the long run is this. And you've laid out for us the probable outcome on tax, which is it's likely to look a lot like how it does now. And then other than that, I guess watch this space. I'll just say personally, when things start getting active, and again, my perspective is a little different because I'm trying to make sure I'm on top of things right when they change for a different reason than advisors. I'll start to monitor some of like the very political, not partisan, but the political kind of the hill.com. Like these guys are like wonky about what's going on in DC type stuff. And then I'll kind of spread out to some of the like tax foundation, all these sorts of things that are commenting on, not because I want their opinions, but because sometimes they'll draw out something that I didn't see in the article because everyone's got their own opinion of what's important and not. And so our job, again, I agree. Like, I don't think the advisor, unless they really care, don't need to go to this level. It's kind of our job to distill this down, but it's out there. That's kind of just my personal process if people really want to get into this stuff. So
yeah, and I'll just emphasize, you know, one thing you just said, because I think it really spoke to me. I sometimes say if you want to have success as a, you know, as an individual in life from finance perspective, you got to turn yourself into the casino. And what I mean by that is, you know, effectively casinos make money very predictably by having the odds in their favor. There are, and long enough, right? Like there are lots of times when someone will come in and win big. There are plenty of nights where a casino will actually lose money. But over time, casinos, because the odds are in their favor, tend to make a lot of money, right? Like it's very hard to lose money as a casino operation, at least just from the gambling side of things. So from a client side, right, it's like, well, if I do this with my investments, I've got a high probability of success. If I do this with my taxes, I've got a high like you do things that put the odds in your favor enough times and turn yourself into the house, into the casino, right? Make the odds in your favor, good decisions over a long enough period of time. If you make them, there's a really, really good chance things will work out. Can't say exactly how, can't say exactly how much, but doing things that are in your favor long enough, keep the odds on your side, and you'll probably do well over time.
Sounds good. Although I need to tell you about my slot machine system I have. That's for another webinar we'll do.
You know, I worked with Ed for a long time. A slot machine means something very different to me. So
Got it. There you go. All right, Jeff, awesome. Appreciate it. Watch this space because I'm sure we'll be back to kind of talk about stuff as it kind of firms up. So,
oh yeah,
Laura,
I can't wait. It's going to be an exciting year.
I hope not. I hope not too exciting. But Laura's giving us the hook. Laura, we'll turn it back over to you. Thanks, Jeff.
Thank you
Thanks,
both
everyone.
so much. That was awesome. All right, so we're gonna take a quick beat, and one of the things that I wanted to share with you was a fun fact. So recently, Holistiplan did a survey to just under 300 advisors, and 99% of advisors have increased their client satisfaction after adding tax planning services. So if you are thinking about starting to offer tax planning, if you're in the very beginning of your journey, I just want you to know that you've come to the right place. And so Holistiplan is the #1 place that's going to help you with tax planning. We have a promo code with a 10% discount right now. We don't often do promo codes, so this is pretty rare for us. So throughout the end of the month of February, we're offering a 10% discount on your first year of a premium subscription. So the best place to get started is really to scan that QR code. From there, you can start a free 7-day trial. And I just wanted to talk through some of the different support that we offer. So we already talked about how we offer consistent webinars weekly, sometimes twice a week for our future customers. But for our existing customers, we offer Tax Planning 101, 201, and 301. So 3 different tiers in addition to ongoing support for advisors as they continue on their tax planning journey. I should also mention that our support team and our customer success team is unmatched. They are some of the best in the world. I can tell you that because I work with them every day. All right, so to lighten it up a little bit, I thought it would be fun if we got some audience participation. If you could just share, what is one emoji that you would use to describe tax season? And if you don't have access to emojis, you could just type it into the chat. Or type it into the Q&A. Oh, okay. Let's see. We're getting the face with the glasses and the mustache, a crazy face, a head exploding face, party face, there's a poop emoji, hiding face, the money sign. All right, cartwheels, hiding. So it seems like a mixed bag of people feeling a little bit intense or intimidated, or like tax planning may or may not be their favorite thing. This is great. Okay, so you're in really good hands. The next session is really going to set you up for success. So with that, I would love to bring on Jennifer Fensley, who is the Wealth Advisor and Personal Wealth Director at CapSouth. We also have Allison Doty. She is the Associate Advisor at CapSouth Wealth Management. These 2 wonderful women have previously done a webinar with Holistiplan, and it was outstanding. People got so much value out of it. So that's it. I'm pumped about this. So thank you both for being here, and I'll hand it over to you.
Thank you. Thanks for having us back. As Laura mentioned, I'm Jennifer Fensley with CapSouth, and so I'm just going to take a few minutes to tell you a little bit who we are. Allison's going to share her screen, navigate. We're going to tag team this. I've been on the other side of these webinars, so let me do a little bit of housekeeping. CapSouth is what I would call a mid-sized company, and so we've gone through several iterations. We are currently in the process of transitioning from founder-led and owned to what we would call Generation 2 led and owned. We are an independent RA. We want to maintain our independence, and so we're working on internal transfers. If I'm considered Generation 3 or 2, then Allison would be Generation 3. in my lifetime, I'd love to see a generation 4 and a generation 5. So I'm actually a career changer. So for those of you that may be newer to tax planning, I hope to give you hope. March 1st will be my 8th year, and I now oversee all of our client work. So we are a company that we have the private client side of our business that we call personal wealth. We also have an institutional side of our business. So I lead a direct group of clients. Allison is my associate advisor. She joined the firm almost 5 years ago with us. Fun fact, literally the week before COVID happened. So what a great time to join a company. She stuck with us, and we're really glad she did. And so, as Laura mentioned, we have been on our own journey with Holistiplan. What I want to share with you guys, if you have been like maybe kind of just starting this journey, there's going to be something in this for you. If you're further along in your journey, we hope to have something for you as well, because we've kind of done it all. And so I want to just offer a lot of encouragement, some key facts. And as Laura mentioned, it was August when we did that webinar. I believe it was called our Blueprint for Client Engagement. We offered a lot of resources. The team's going to link to that. The Holistiplan team is fabulous. So as we go along, I'm going to answer questions when Allison takes over. She might jump in at the chat and answer some questions while I'm talking. I'm going to kind of talk more about our business aspect of it. And then Allison's going to take you through her journey, especially if you have younger advisors, training opportunities. I want you to hear from her about how she has found her way within our company, her specific journey. So especially if you're a younger advisor on this, she's a great source of inspiration. And then she's going to take you through high level, some case studies. We're not going to get into the depths of how to use the tools, but just really want you to see how you can really use Holistiplan at any stage of your journey. So we're just going to start with some of the basics. Like, why should you be doing tax planning? When we get into this, and Allison, are you going to drive for me? We'd be able to
I'll drive for you. Go ahead.
Perfect. So when we talk about why tax planning, it's really going to be a couple of key things here. And can everybody see this? I'm still seeing the main slide. There we go. Perfect. Awesome. So why should you be considering tax planning? I like to talk about the sea of sameness. If you are a potential client looking at your firm, how are you going to stand out? Some of you have done an amazing job with a very specific niche. We're not there yet. We're definitely on our way to that. And so one of the ways that we felt like we could do this is through tax planning. It could really be the missing piece for advisors, and you don't have to be a Jeff and have all of that knowledge. Holistiplan is going to make it really easy for you to look very smart, make it scalable, and to create a very amazing client experience. So you will find I don't take myself too seriously, and so Allison and I will probably laugh along the way. Wish you could be joining in with us. But again, we feel like our journey and what we've been doing with Holistiplan, we can speak from someone who was new to the industry and started as a one-woman show and then worked with a two-person team, really being like myself and Allison, now to leading multiple teams. It doesn't matter what size your firm is, whether you're solo or whether you're a very large firm, you can find something about this tool to make it amazing for you. Boosting client engagement. I think at this point, our clients are looking to us to be proactive. I really hate to be in the seat when a client's coming to me and calling out something that maybe I hadn't brought up with them. So for us, as you grow particularly, and we are very growth focused and we want to continue to do that, we believe that will create employee opportunities, opportunities to serve more clients. And so for us, we need things that are going to help us make it scalable. I'll talk a little bit later about how we did it and how it wasn't scalable, and so how Holistiplan has really helped us on that journey. And you're going to see me look over to the side because I'm going to try to track some of these questions and answer these along the way. So using Holistiplan can really help you shift from being reactive to proactive before your clients are bringing things to your attention. And then it really, I think you'll see this along our presentation, it's going to be able to offer you and your clients a lot of value without increasing a lot of the workload that you have to do. So when we talk about scalability, that's what we're looking for, because let's be honest, our time is very valuable, and how we do that and how we serve more clients, we have to really pay attention to it. So when we're looking to add to a tech stack, because this landscape in our advisory world is full of amazing technology, but how many of you have been in the seat where you have to literally spend hours trying to figure out how to use it and then figure out how you're going to show it with a client? To me, Holistiplan offers some of the most easiest, lowest barriers to entry, and the cost is incredibly reasonable and scalable. So let's just talk about our evolution and how we did this from a standpoint of where we were at and then kind of next steps. So before we started using Holistiplan, we were very inconsistent. I would say that a very manual aspect, and we can just go to the next slide if we have an opportunity for that. So we have an amazing person on our team. His name is Lewis Robinson. He had a very successful CPA practice. Later in life, he joined our company. I say he's amazing because he actually was my advisor, because I was a client of the company before I joined. And so Lewis was the person. Back then, we were very siloed. We had teams that could do it however they wanted. They were doing things differently, different technology. And so Lewis is the person that brought Holistiplan to Cap South. I think it speaks amazing volumes about him as a person and just how his curiosity. But before that, Lewis had amazing spreadsheets. He had tools that he could use as a CPA. Rest of us, no way that we could have been doing that. I would say that if we were looking at tax returns consistently across the company, that would have been considered a win. So that, again, I've only been here 8 years, and Holistiplan, I believe, was started in 2019. Roger can correct me on that one. So it's not like this has been a really long journey of tax planning and how we've started to where we are today. So um, now we got curious with what Lewis was doing. And so we would start having company calls. We found something that was very small for us to be able to do, which was simply uploading the tax return into Holistiplan and creating what we would call the taxable observation report. Super easy to do, lots of webinars on it. And so we were like, hey, let's just start here. So that, I believe, was one of the first things that we did as a company. And then through that, I started looking for ways like, how could I learn? How could I make my client experience back when it was really just me and a couple of people? What could we be doing to set ourselves apart? How could we help our clients? How could we answer questions? And how could we grow and learn with them and continue to offer value? So curiosity is one of the things, one of our core values at Cap South that we love. And so Holistiplan made that very easy to learn and to dive in. And we started very small. Again, we'll talk a little bit about this and how we did it later on, but we would just look for things that we could try. And we do it with a small group of clients. We would get pretty comfortable, and then we would roll that out. So the middle became, all right, Allison and I developing things for clients, maybe sharing it with one or two advisors, but not this confidence across the company to adopt that. And really, that most recent part of our journey has been in the last 18 months to 24 months. So again, pretty short period of time in our advisory life cycle. And now what we've been doing at Cap South is across all the teams and the client services group is creating this very structured, scalable experience, leveraging Holistiplan. We've taken what we've created as this Cap South blueprint for engagement. I'll show you just our timeline of that at the very end. And again, there's a whole webinar that refers to that. And now it's become proactive, what we do at the beginning of the year. So we've been doing things for the last few months for clients, all the way through what happens when we get the tax returns, how do we review the tax returns, what information are we providing, utilizing the newest insurance tools. We do that kind of in our summertime. And then how do we keep touching these tax scenarios? So if you're not familiar with the tax scenarios, we'll talk a little bit about that in a case study. But you heard the baseline scenario referenced, and that's something you're going to hear Allison talk about several times. But whether it's creating that baseline at the beginning of the year and coming to revisit it, it's made what we used to do probably at the end of the year, like trying to chew up a bunch of planning. it's made it a very scalable, structured process for us as a team. And now we're rolling that out through the entire company. By the end of this year, we will have almost every client that is paying for those services, because we do structure our client base in tiers. And so not everyone gets every service. We price and scale on complexity. But at the end of the year, everyone that is receiving our tax planning services will have a very consistent, planned, structured, and scalable process. So we've come a long way from those early days, and especially the early days of having to call Lewis and asking him to maybe help us with everything. Now we just leverage his expertise. So it's like having our own Jeff on the team, which is really fun and exciting. So want to transition a little bit to our implementation process. So one of the things that you heard me say was starting small. Probably my favorite thing about this industry is how many people are willing to help. And so if you haven't found those, count Allison and I as your people. Okay. So some of the best advice we've ever gotten was words of wisdom that said, what's safe to try? And so that's what I would encourage you with today. So just choose one feature. And again, for some of you who are newer to Holistiplan, some of these terms, you may not know what they mean, but I promise you, you'll learn very quickly. So the milestone report, probably the easiest thing that you can start with here. If you have clients loaded into the system and you have some of their key demographic information, every year you can just run a milestone report. Very easy. It's going to tell you all the key things that you need to be paying attention to. And so I say something like a milestone report, which for those of you that are the power users and probably using it even more than we're using it, could seem really small, but especially as you start to grow and scale your practice, you may not have the luxury of having all that information at your fingertips. So don't forget some of the things that maybe we take for granted every day. You've heard Laura talk about the training. My opinion, and it's no offense to any of our other tech partners who I also love dearly, but I think Holistiplan has some of the most comprehensive training I have ever seen. If you take someone like me who was a career changer, self-starter, like really just trying to learn things on her own and then figure things out with the help of others internally, going to them and asking questions, but maybe not having someone to be able to sit down and teach her everything, being able to sign up for Holistiplan 101, 201, 301. There's all these new user trainings. And then probably the biggest thing, and Deborah Taylor knows that we're huge fans of hers, was the masterclass. I believe we sat in the very first masterclass. And what you will find with the training is they're not only going to teach you how to use the technology, but they're also, like we just heard Jeff talk about, going to help you think about things in a new and different way. They're going to teach you about what we should be thinking about. And they're also going to teach you ways to integrate this into your business. There's tremendous amount of materials, marketing materials. If I sound like a sales ad, I promise you we're not getting paid for this. It's just because we are Holistiplan fans so much. We love to nerd out over this, and we just believe in it so much and what it's done for us that we want you to feel as confident in the tools as we do. So once you start to get your feet under you, it is very intimidating if you've got a whole host of clients to figure out how do you do this well for everyone. So again, my encouragement is segment your business. Choose a few to test and learn on, right? So we have had those clients, like as Allison and I get used to new features, we have those clients that we know love new technology, we can be very vulnerable with them and say, hey, we're learning this. Could we show this to you? Could we get your feedback? Clients love giving their feedback, at least that's our experience. And so being able to slowly build upon time, get really comfortable with one, choose a few clients, roll that out to the rest of your clients that you feel need to be doing it, then go on to the next thing. If you keep doing that, small steps are going to add up to very big wins. You're going to be incredibly proactive, and eventually you're going to get to where we are today, which is this very comprehensive tax planning calendar that are going to provide you touch points along the way without having to have major meetings, not a huge time suck, and you're going to just increase your value tremendously. Your business growth is a Holistiplan. If you are like us and you are trying to grow your business, it is really something that you need to know is that Holistiplan is not just a tool. It can be a very effective business growth strategy. It is all of these four things, right? So for us, we very much value deep client relationships. I think that the push pull for those of you, and I think it's probably the majority of you on this webinar, want to have very deep relationships with your clients. But how in the world do you continue to have that value, that leverage, and offer things that are going to be scalable? You've got to be able to build trust. You've got to find ways to earn the trust and respect of new clients, especially if they're coming to you from the website, which we're very fortunate to have a lot of people who are not just referrals, but who have found us along the way. And then for those referrals, even though we've got a leg up with them because we have great client referrals who are opening the door for us, we still need to earn their trust and respect. And we know trust takes time to build. So by being able to look at their tax return and offering just immediate insight, you're building credibility, you're offering a value, and Holistiplan is going to make that very easy to do and very scalable. It's also, we just heard Roger and Jeff talking about the planning opportunities. This industry is never boring. There's something always changing. And so I am always amazed at the team's responsiveness. You will always see when you log in, like all the updates. It can be sometimes overwhelming to keep up with all the updates, but they will tell you what they are. They're going to offer training. You can go back and watch the webinars. They're going to build it in. And so it makes staying on the forefront of the things that you need to be talking about with your clients very easy. Again, our time is precious. I know you've carved out a lot of time today to be on this webinar, so it tells me you're very serious about this. And I still believe that Holistiplan is probably the most bang for your buck that you can use right now to do this. Scalable and efficient. I'm going to sound like a broken record, but you have to be able to create this efficiency. And again, in order to spend time with the clients, your workflows and the things that you're doing behind the scenes, especially for your teams, if you're going to start leveraging associated advisors, your client service associates, other people within your company, this is a great opportunity for them to step up and lead. It is a very safe place for them to learn, to grow, and it makes it, again, an opportunity to roll out services for clients that you may have not been able to do in other areas. I know that most of us delve into a couple of different areas where we're looking at estate planning, tax planning, risk management. Still, Holistiplan is going to be one of your best opportunities to bring a variety of tiered services, because again, within Holistiplan itself, you could look at offering different services to different segments of your clients. That too will continue to move your existing clients up the continuum of services. You can also talk about things very differently with your prospects as they're sitting down. And no better way to call it an opportunity or find some new planning opportunities to just ask for a copy of that tax return, upload it. It's a great way to get to know them very quickly. Um, all of this together is just going to continue to enhance your value proposition. When I look at this, it's going to position you as this educator. You're going to be their guide on the journey. It's going to offer you a new way to have a conversation with a client. You can have, we like to call them topical meetings. We used to do these very large meetings where we would just meet with clients once or twice a year. We would save all this information, we'd kind of dump it out on the table. Clients, if you've been like us, you've probably done it too. You get the little glassy-eyed look where they're like, what? So now we break this up into topics, and clients love diving into their taxes. If you can offer them opportunities to save some money or to look for some different ways to have a conversation that they've never engaged in, particularly clients or prospects that are shopping around advisors, this is going to be a way for you to set yourself apart. And I will be very honest, I could not do what I do today without an amazing associate advisor. And so I've asked Allison to spend time talking to you today about her journey. If you have not introduced an associate advisor to your practice, I think it's one of the best things you can be considering doing. We have a whole host of young planners out there who are very eager, and her journey with Holistiplan, I think, is something that you can easily replicate. And she leads financial study groups, and she is teaching other younger planners. So Allison, take it away.
Awesome. So like many of you others, whenever I first started the industry, I really turned to podcasts, books, articles, anything I could find for guidance and knowledge that I needed to become a lead advisor. I vividly remember a Kitsis and Carl episode. That's one of my favorite podcasts, where Michael Kitsis talked about finding your mini specialization and really becoming a subject matter expert in a specific area. So for me, that area became tax planning. And a lot of that was due to Holistiplan's help and my journey with Holistiplan. So when our firm first set out to expand our knowledge with Holistiplan, we committed to learning everything we could. So we sat in all the W. Taylor mastermind classes, like Jennifer mentioned. We listened to all the Holistiplan webinars. We did all the trainings. And Holistiplan is really just an incredible tool when you first start out, because they have a huge treasure trove of all these different trainings, and it's all really just at your fingertips. And their help sites are so easy if you have requests. So the key for us was to, like Jennifer mentioned, really just master one specific feature at a time, build out our standard process for that feature, and then move on to the next tool. As a next-gen planner transitioning into my associate advisor role, I was really looking for those opportunities where I could speak more in client meetings and find a way that I could contribute to actually show value. And so scenario analysis really became that tool for me. It helped me build my confidence in discussing tax planning, and it really enhanced my communication skills by providing a live tool that I could really talk through with clients in client meetings. Eventually, it took a little bit, but eventually I became one of the internal specialists for Holistiplan with our firm. So my role evolved, like Jennifer mentioned. It involved building out those service calendars for our clients, so that way we could have touch points throughout the entire year. All right. So the next few slides, we're going to get into actual client case studies. So if you're just starting your journey with Holistiplan, the tax scenario analysis tool may be a little bit intimidating, but there's an easy win in the beginning. You can start small by providing meaningful values to your clients. A simple yet impactful way to begin is really just helping clients project their potential tax liability for the year, especially those that are working that may just have some differences in income, like a bonus or stock vesting, different things like that. So for our team specifically, we kick off the year by requesting all December pay stubs and pay stubs for January. This allows us to establish a rough baseline projection for each client's tax situation for the year. You heard Jeff talk about the baseline, so we won't get too much into it, but essentially our definition is an initial estimate based on expected income, deductions, withholdings, really just everything that encompasses a client's tax situation. If a client later receives a bonus or has another taxable event regarding their income, we request that corresponding pay stub, and then we're just able to adjust the models on the fly. All right, so seeing this specific scenario in action, we recently worked with a client who was impacted by firm-wide layoffs. As an executive, he had unvested stock, and a large portion of this stock vested at the beginning of this year. By obtaining all of those pay stubs that showed each of the restricted stock units vesting, the projection showed a significant shortfall in the withholdings on his restricted stock units. That really resulted in a larger estimated tax liability. However, because we started planning for him and creating that baseline at the beginning of this year, he's got all of this year and the beginning of next year, obviously, to start working on saving for that tax bill. So that really just offers peace of mind for the client. All right, the next level, if you will, of scenario analysis. So as with our scenario planning process, we begin by establishing a baseline, like we keep talking about. From there, we can model out various tax strategies like bracket conversions at the start of the year. This gives us an estimate of how much can be converted before reaching the next tax bracket. So to see this in action with one of our clients, we work with a married CPA couple who prioritizes executing Roth conversions while staying below the 24% tax bracket. So filling up that 24% tax bracket, AKA a bracket conversion. At the start of January this year, we met with them to review their 2025 projected baseline. This meeting really served as just an opportunity to address any questions and clarify all the details that we had laid out. In this particular case, the clients do have rental income, so we're able to talk with them about their expected income for the year and then any expenses that they have, really honing in on that baseline for them. For these clients, we actually did implement a barbelled Roth conversion strategy, which is essentially processing a portion of the Roth conversion at the beginning of the year, and then later in the year, once we have the projections a little bit more concrete, we will revisit the scenario tool and complete the remainder of the bracket conversion. All right, and then this is the higher level scenario planning. So these are for our power users of Holistiplan and the scenario tool. So in this case, the clients had received a pension once the company was acquired, the company that they worked for, they received an unexpected lump sum payout. Since they had retired a few years before becoming eligible for Medicare, our challenge was to really carefully manage their distribution strategy paired with their specific request to maintain their Affordable Care Act credits, premium tax credits. So a key feature in Holistiplan's scenario analysis tool really helped us with the planning, and we were able to show the clients this specific scenario. So by expanding the modified adjusted gross income tool, it's at the very bottom of scenario analysis. I believe it's right above the federal tax portion. We can determine what percentage of the federal poverty line the client falls into. This really allows us to make those strategic decisions that optimize the client's healthcare subsidies. All right, enough of the case studies. Back to you, Jen. Oh, you're muted.
Thanks. I was tapping away answering questions. So I'll throw you a curveball here. We're going to get to this because I've been answering a lot of questions on the side. But will you talk just a little bit more about your confidence in speaking into meetings and just how, like, as an associate advisor, using Holistiplan has made that a little bit easier for you?
Yeah, so in the beginning, like I mentioned, I really was nervous in kind of all the different areas to talk about because I had just started out in the industry. And so after that episode of Kitses and Carl, I was really trying to find my one subject area to really start to hone in on and really increase my knowledge. So I knew I could speak to that because, like we've been talking about, we kind of start small and then we build on that. And so taxes actually became that for me. And I was able to really start creating those baseline scenarios for clients with work with Jen. She was checking over my work. We were working on it together. And then I started being able to model out more difficult strategies. And so honestly, that increased my confidence in communicating with clients in the beginning. And then it just trickled over into other areas, but it really started out with tax planning. So.
Absolutely. Well,
yeah.
I'm very biased. I think I have one of the best in the industry. She's now on the Next Gen National Board for FPA. So if you have younger advisors, I would encourage you to have them reach out to Allison. I've gotten a couple of questions just about, can you reach out to us? Absolutely. So find us on LinkedIn. The team will probably share our information as well. There are so many people that have helped us in our company, and so we absolutely want to give back. And we know that we're going to stay pretty high level today on a lot of areas. So if you want to go deeper, or if you want to watch the other webinar and really dive into how we created that blueprint for engagement, we are happy to answer those questions and spend time with you. So before I jump into answering some of this, because I saw some consistent questions, one of them is going to be around the CPAs. I also just want to talk about like how we price and how tax planning works into that. So for us, we price around complexity, and we have a fabulous complexity calculator. People way smarter than me in our company created for us, and it's just been this amazing collaboration. So when we are doing financial planning for clients, one of the baseline things that every person that is paying for planning receives is going to be the tax observation report. So that is just a great way. It is mutually beneficial for us and for them to get that report, to look for planning opportunities, which may increase engagement. We try not to force clients into working with us in a certain way. We want to meet them where they're at. Sometimes it takes some opportunities and some time to build that trust. And so sometimes clients start with us, they start small with us, and then they grow in their relationship, or they come to us in that wealth accumulation mode. And so they have a continuum that they can grow. So then when we're talking about the heavier lifting, the tax scenarios, getting into that, we choose to charge a little bit more for that. And that kind of goes up the continuum for complexity. When we are like doing collaboration planning with CPAs, and we certainly have our more complex clients where we are talking to them consistently, then those are going to be a little bit more up our pricing continuum. So the key thing about collaborating with CPAs is like always knowing that we are doing the planning and they do the advice. We are fortunate to work with some fabulous CPAs, but I will still say that the majority of our clients have a tax preparer. Let's just put it that way. So we are always giving the compliance caveats. Every report's going to have that on. We will talk to them about it. We will say, please talk to your CPA if we don't have a relationship with them. But with our clients where we have existing relationships, and so just so you guys know, we have clients in about 18 states, so we don't have the luxury of just being in one place and having this community and network of people. But we do have some very strong CPAs that we will put our ideas together. They will look over it. We're starting to find more and more they were relying on us. And that's fine. We enjoy those relationships, and it's mutually beneficial for the client. So we're able to kind of think through things and then share reports. One of the things that we did not talk about and outline for you guys in this presentation, but it is in our other, is the tax prep letter. And so that's a really cool feature that you have to, in our opinion, be a little forward thinking on. And you can create a tax prep letter for the CPA, and you can create a tax prep letter for the client. CPAs love that. So if you are looking for ways to build that collaboration or introduce yourself, I would consider looking for those types of communications that are going to make their job easier or make them have a little bit of trust with you as just that easy entry. Client data security, Holistiplan, if you go on their website, has a great section on security. Please reach out to the team, but I know sometimes people are concerned about their, what does their data look like? I know that some advisors choose to redact data. We are not currently doing that. We feel very confident in the systems. It's multi-factor authentication. There's just a myriad of ways that the client data is going to be protected. Roger and his team can certainly answer those security questions for you. And then a lot of things that I'm seeing in the chat are really about like setting boundaries and managing expectations. So wanted to spend a little bit time here. I will say these kind of go like hand in hand. We learn sometimes the hard way, and I don't mind sharing that with you. But first of all, managing expectations, because I have yet to be able to answer this question, but it's talking about like surprises at the end of the year. Our approach is to never push something up to that like very last line. So I know we're going to get into the Roth conversion tool and talking about that, but we always like to give ourselves a buffer. We never want to be, especially if we're looking at bracket conversions or we might have a surprise. The great thing about Holistiplan is you can see year over year tax returns, and so you can start to see trends. There's always going to be that client that had something happen that we didn't know about. And so we're generally going to give ourselves a pretty nice buffers to make sure that we just don't end up crossing a threshold that we didn't intend to do. So we're not going to try to squeeze the very last dollar out of it. So that's just one way that we set expectations for the client. The other thing that we started to do by like doing the tax observation reports is sometimes you found errors. whether it was missing forms or then as part of our practice to beyond the observation report to go through the tax return and call out those planning opportunities. One of the most common ones that we see is the 1099 distributions, 1099-R distributions, and QCDs. And so it is not unusual for us to catch errors, and we make zero promises. Maybe we're a little too good at catching things these days, but we consistently have to remind clients that we are not here to review their tax returns before they submit it, because now we have clients that ask us to do that, and we do not do that for them. I think we've encouraged them to find a new CPA. But there's also some others that just have this very high reliance on us looking at their tax return. So again, just consistent messaging, reminding them of our role versus the CPA's role, very, very important throughout this. And then I think it's just, again, making sure that as we go through scenario planning, I think we do this with all of our aspects of planning, and I'm sure you guys do as well. Life happens, things change. So that's why we don't want to just touch it once and not revisit it before the end of the year. The scenario planning tools make it very easy to relook at it. If the team is going to make an update, the Holistiplan team is going to make an update throughout the year, we're going to see that. Tax law changes coming down the pipeline. We know we're going to have to be ahead of it, paying attention, and proactive communication is probably your best friend in all of this. And so when we look at, and I know that we've gotten some questions, Allison, before we move on, just
Yeah.
particularly around like where you can find that ACA breakdown. Yes, it does hide a little bit. So Allison, can you just touch on that high level?
Of course, I actually pulled up a Holistiplan on my end to find that answer for someone. So essentially, if you go into the scenario analysis tool, and then you scroll towards the very bottom, right above federal withholdings calculator, there's a button there's a section that says MAGI, so modified adjusted gross income. If you just expand that section and you scroll to the bottom, it's in the MAGI group 6. So it's towards the very bottom, and that'll show you the ACA premium credits. Yep.
Another question that is just about how are we sending tax reports, tax observations, scenario reporting. So we have a secure email system. If a client is really concerned about receiving that via email, there are portals that we have that we upload, but we make sure that we send all of our client communication like that securely so that they feel comfortable with it. And most of the time we are delivering the reports ahead of time, or we are going to just have a quick meeting about it and we're going to pull the tool up and go over it. Our compliance team is really amazing. They are easy to work with. So I apologize for those of you that don't have an easy compliance team. We're very fortunate. And I feel like we have really made sure our disclosures are the way that we want them on all of our reporting. And once compliance is comfortable with that, then we're allowed to run the report. We save that to the client folders. We have that for references, and then we're allowed to provide that to the client. And there are so many different types of reports that you can provide. So I think it's another great thing once you're building your confidence in the scenario planning. If you talk about that baseline, and then you heard Jeff talk about what ifs, and I feel like we all can speak that language, provide them multiples so that they can take time to look at it. I'm sure you have all had the client experience where they're nodding in agreement in the meeting, but they may not be having that sink in. And I really do find that it is a situation where if they can look at it, they start to understand it, you can educate it. One of my dear friends who we meet pretty monthly is on this call. And he's really been able to position himself with Holistiplan as this educator and walking your client through their tax return and demystifying their tax process and making sure that they're coming alongside of you as a partner. And so finding those ways where you can use the tool for education, not just making yourself look a lot smarter and adding value, is a wonderful way to create those strong relationships with your clients. I just find that many of our clients are hesitant to admit that they may not know something, no matter what their life experience or age has been. And as Allison was sharing in that case study earlier, one of the ones that we're doing conversions with, they are two CPAs who are retired and they love seeing the Holistiplan data. So you talk about like engaging CPAs. I just have not had an experience where we end up in a relationship where we're fighting against CPAs. Maybe we're just fortunate. But I feel like anybody that is collaborating with you to make the client's life better, great partners to have, find those and then see if you can refer clients to them and continue to build their network, and you might experience the same as well. So we'll answer some more of these questions offered to the side. I know one of them is like, do we charge a base fee for Holistiplan? We don't. We just make it as part of our engagement. We did have an opportunity last year, Allison and I, clients came to us. They are a child of a client, but they are in their early 50s. They're looking to retire. They made it very clear to us that they only wanted to do a one-time limited engagement. We generally don't do that because their parents had been with us for a really long time, a great client of ours. We made an exception, and it was just one of those experiences that throughout the year, Holistiplan was the thing that they gravitated to most. And we brought up some challenges that they might have. We showed them what would happen now in Holistiplan, but through our other software, we're able to project out like all that great saving they did in their pre-tax 401k is going to turn into a challenge for them. And so we like to show the long range tax planning and the short-term tax planning and have that communication. So they're actually now paying us a fee. It's a separate standing engagement. We did it specifically for them, but I could see us continuing to roll that out for clients. I think you could easily adapt this to your practice based on how you charge. They are specifically paying us to run tax scenarios for them. So that was our huge Holistiplan tax planning win, and just goes to illustrate that even those very skeptical clients who were like, I know this planning software, they'd worked with another advisor who had retired, used the same exact planning software as we had, did not have Holistiplan. We changed the conversation, and then we got an ongoing engagement with them. And just as you look to keep that transfer of wealth in-house, those are some things you need to be considering. So Allison, let's take it home. Let's go hit the last slide.
All right, I'm trying to answer some questions. There we go.
Advanced strategies. So again, once you've started, and some of you I know are well into your Holistiplan journey and you're using scenario modeling incredibly well. If you are someone who loves this tool as much as we do, but you haven't really built out your engagement, that is where I would encourage the heavy Holistiplan users to take it to the next level. You can start to build your client engagement, create seasonal planning, then build the service calendar for them. And Allison, if you'll hit the next slide, that will give them a quick timeline. Again, all of these things are spelled out for you in our previous presentation. So this is just our seasonal service calendar, and it is specific to what we are doing in Holistiplan. So again, you're bang for your buck in our world where tech is just overwhelming and we're making smart money decisions on how to spend and how to enhance our businesses. These are all the things that you can do to build client engagement. And I'm sure some of you have other things that we have not considered. So if you see something that we're not doing and you're doing, let us know. We always want to keep learning and improving. But you can see all the different touches and the ways to use the tool. And then if you get to the very end, we're just going to keep reiterating that you've got to start small. Find out what's safe to try. It is progress over perfection. It is very easy to get started today. I don't think I've seen them offer a discount. So if you haven't started your Holistiplan journey, I would snatch that up and certainly talk to the team. And the other thing that we love them about the Holistiplan so much is that the entire team welcomes feedback. They continue to pour into the tool. Time and time again, we've seen too many tech companies start to grow and gain so much traction that they just kind of quit innovating, and this team never does. You heard Roger talking about coding, so we know that there's always going to be more great things to come. So it is an amazing opportunity for anyone to leverage into their practice and provide value and opportunity for their clients. So again, happy to help. Ask us any questions. I know that we'll try to answer as many as the side. I know we're going to try to catch up a little bit on time and maybe take a break. So Laura or Roger, if you'd like to jump in and tell us our next steps, we're happy to turn it over.
Hey, thank you so much. That was awesome. As usual, amazing. So super, super appreciate you guys being here. It's always so informative and you just make it feel so approachable and so doable. And I think that's a real differentiator. So
That's because you guys make it easy. So thanks for
Yeah.
all that you guys do.
I mean, there was a lot of tension in those emojis. So you did a really nice job breaking it down and just step by step. So thank you both so much for being here. I know our audience got a ton of value out of it.
Awesome. Thanks for having us.
Thank you.
All right, so I have one more statistic for you, and then we're going to take a very quick break. So here's a fun fact for you. We did a poll to some of our advisors, and 76% of our advisors saved a minimum of 1 to 2 hours when reviewing a tax return. Our software can produce the tax report in 60 seconds, which is a 98% reduction in time savings. When you multiply that out by the over 1 million tax returns Holistiplan has processed, Holistiplan has saved advisors a minimum of 132,000 days or 509 years. So food for thought. If you haven't yet started with Holistiplan, now is a really, really incredible opportunity to get started. All right, welcome back. We have about 1 more minute to go till break is over, but while we're waiting, I thought it would be fun for everybody to participate since the emoji thing I think went pretty well. What is one piece of tax jargon that you secretly Googled? You just drop that into the chat. I know there's a lot. We have a ton of tax jargon here at Holistiplan. TCJA, that's a good one. W3.
Please. I like please.
Please or please?
That's my favorite. That's my favorite. Oh, peas. I read it as please.
Yeah.
I like that as tax jargon. Please.
The please limitation on.
Yeah.
Itemized.
Limit my kids from saying please before I just say no.
You know, I'll tell you, like, by the way, there was a lot of talk in the last call about like Roger coding the stuff. That was true like years ago. Like there are moments where Jeff and I would be up in the middle of the night and he's writing a tweet storm and I'm coding the stuff. Like that's not how it is now. There are actual qualified people coding in the tax stuff in Holistiplan now. So don't worry about that. It's not Roger slamming Red Bulls at 1 a.m. It's actual qualified people. But P's amendment brought to mind, you know, we had to code the entire 2017 tax code into our system because we have the option to either sunset or not. And if you recall Jeff's session, he's like, maybe you don't worry about the sunset actually happening, but we had to build that. And that meant we had to go back to 2017 that had things like the miscellaneous deductions. It had the P's limitation on itemized deductions, which was a income-based limitation that would reduce your itemized deduction. It had exemptions. Anyway, we had to code all that junk. So basically, we had to do 2 whole tax systems in our system. And I look forward to the day of deleting all that 2017 stuff. Again, I'm not making policy choices here. It's just like a code cleanup choice. But yeah. All right, there we are.
Oh, who
right.
are those?
We ready?
Who invited these guys?
These 2 amazing thought leaders. So I'd love to do a quick intro so I can brag about you guys a little bit. So Roger Pine is the CEO and co-founder of Holistiplan. Obviously, he's amazing. That's why he's here. He leads the thought leadership and the product development and just, you know, the entire direction of Holistiplan. And Ben Birken is our VP of customer service here at Holistiplan, and he's also the founder of Pisces Financial Advice. So love to turn it over to you. I know there's a ton of new develops on the Roth projection tool, and you're going to walk us through it. All right.
We are. That's what we're gonna do. So you know, we're gonna build on, you know, if we jump in not as far back as 2017, but all the way back to November, right, of last year, which feels like a million years ago, but it wasn't that long ago. Roger and I did a webinar where we excitedly talked about one of the new tools that we had inside the Holistiplan system, our Roth projection tool, where we took what was a 1-year projection tool within scenario analysis. Now we have a separate projection tool where you can do multiple years of Roth conversions and show the long-term outcome and things like that. So we're actually going to take today to build on that, to walk through a few of the new things, and we're going to do it within the context of a case study. So Roger, I'm going to share my screen. As I'm sharing my screen, is there anything that you want to share with the people as I try to remember, like, we work at a technology company and how to use technology?
Yeah, I mean, like, Roth conversions are the #1 thing that people are coming to Holistiplan to do. Still, it's the, it's the most accessible tax planning strategy there is. It's a way of bringing income into the year and then getting a long-term payoff for it. For years, we kind of didn't get involved in the conversation about what is the long-term value of doing a Roth conversion. We kind of thought of ourselves as like, we're a tactical financial planning software. And so we're going to help you do the tactics of that. We're going to help you do the 1-year modeling of that Roth conversion you're going to do. Ben is going to show you our range calc feature, which a lot of people who are doing Roth conversions use to really kind of hone in on how you fill a bracket, which is still true. But advisors again and again were like, man, can you just show me how the long-term benefit of this Roth conversion plays out? And we're like, no, man, you got other tools for that. And again, advisors were like, no, you're the tool we want to do it. So finally, we were like, you know what? It's true. To really be a complete tax planning software, we need to have the full end-to-end capability of model out the Roth conversion in advance. I'm working out with the client the plan of what we're going to do. Okay. Then when we get into the years, that's when we get into the tactical. And we're going to show all this, by the way. We're going to get into the tactical. Okay. Our plan that I discussed with the client is we're filling our brackets, between retirement and taking Social Security or whatever we're going to model. And then, like, how do I actually get it down to the right dollar amount? Because when you're kind of in broad brush strokes drawing it up in a projection, that's different level of detail than the tactics. So anyway, we eventually have built out a full end-to-end capability of telling this story. So yeah, that's what Ben is going to try to show you in the time that we've got today.
Awesome, thank you. So for those of you who are familiar with Holistiplan, we've got incredibly creative naming conventions for our sample folks. So this is our retiree couple, Robert and Roxanne retiree. For the purposes of today, Robert is 67, turned 68 later this year. He's already collecting Social Security. Roxanne is 66. She turned 67 this year, has not collected Social Security, but plans to do so when she turns 70. And what we're looking at here is the tax report from their 2024 tax return, because most tax planning is going to start with this baseline of, well, what happened last year, and is last year a reasonable enough assumption to at least, like our last folks talked about, what's our baseline for this year, right? And so we're going to look at Robert and Roxanne. They're only taking Social Security, and only one of them is taking Social Security, not yet at required minimum distribution age, so living off of other investments, relatively low income, in fact, incredibly low income from a tax point of view, to the point where their deductions ate away all of their ordinary income. They had a total tax of 0. They're sitting comfortably in the 10% tax bracket. So, prime opportunity here for Roth conversion in that sort of golden window where you're maybe taking Social Security, maybe not, but not yet having to take money out of your IRAs. We're going to use this as our jumping off point, right? We're going to eyeball something here that we're going to use for our, hey, I think we can do a few years worth of projections or of conversions coming off of this particular document, and then we'll fine tune it a little bit later on, like Roger said. So if I'm looking at this and I'm focusing here on this ordinary income part of this marginal tax bracket chart, I'm seeing I can probably add another $200,000 or so of ordinary income through a Roth conversion, right? Because that's what a Roth conversion is, ordinary income, right? We're taking money out of the IRA, having to pay taxes on it, and still stay within, the 22% tax bracket. Now, again, I'm not getting super detailed, right? I'm just doing an eyeball idea here. I'm going to use that as my starting point for when we move over to the Roth projections page. I think I can do, somewhere in the ballpark of $200,000, but I'm also going to have to acknowledge I might want to scale that back a little bit, because like I said, I've only got one member of this household taking Social Security. The other member is going to take Social Security in a couple of years. So maybe I do 200,000 for a few years, and then I scale it back some by the amount of the spouse's Social Security amount. So I'm just going to set that up as a backdrop. To navigate to the Roth projection tool, we have to go back into the client's household. We're going to scroll down until we see this Roth projection section, right? So it says Roth projections. We're going to walk through how you would actually do this, screen by screen. For those of you who have seen it before, so it's a good refresher. For those who have never seen it before, an introduction. We're going to create a Roth projection. The first screen that we come up with is, well, what's our name, right? We got to call a name for this because you might have a few different projections on here, each with some slightly different assumptions. So we're going to call this 2025 sample. You might be wondering, why are you asked for a filing status within a household where there's 2 people? It's because we don't really know, right? You know, this was their filing status last year, but maybe somebody was deceased, or maybe there was a divorce or something happened. So every projection is going to ask you to indicate the filing status, the start year, we're going to use 2025, and then identify the 2 taxpayers within the projection itself. Sometimes we get the question, why do you have the different taxpayers? Well, if you're doing married filing separately, you might want to pick one taxpayer versus the other, right? In this case, we got a married filing joint. We're going to identify taxpayer 1 is Robert, taxpayer 2 is Roxanne. The other item that is on this particular screen, you know, Holistiplan can calculate the additional standard deduction for individuals that are over age 65. We can also calculate the additional standard deduction if somebody is blind, but we won't know that unless you tell us, right?
Ben,
so if you know that your client is blind, you would just go ahead and mark one of these buttons right here.
Real quick,
yes, Roger.
can you zoom in a little bit, Ben?
Yeah.
We're getting a few other questions that are kind of like, okay, what about in this case, or why'd you pick 22%? We're trying to run a case study. Like it, you know, your mileage may vary for your client. I mean, like we're trying to show how we're running through an example of a client who's in a low income kind of valley, and we know they're going to have higher income later. 22 or 12. There's a lot of good stuff discussions we could have around that. In fact, well, actually, Ben, that's a good example of our optimization piece we're going to talk about at the very end. That's coming. But,
yep. So yeah, let me back up and say, you know, even though Roger and I are both CFPs, this is not tax advice. This is not, hey, this is what you should always do in every situation. This is just us running through an example of how you can use that tool, right?
Correct.
Does that seem
Yeah.
fair? Yeah. Okay.
Right.
So I've created our sample. We're going to jump to that projection here. The first time you come into the projection, you are going to be prompted to supply some additional information that we would need to know that we couldn't extract just from the tax return itself. So it's going to be a series of 3 screens. We're going to start on the first one. And the first one is really, you know, what I just mentioned, you know, what are the Roth conversions that we're going to be doing? And again, I'd set up what we were going to be doing ahead of time so that I didn't have to explain it again here. But the idea is, you know, we ballparked in 2025, you know, conversion of about $200,000. We're going to have that go, we'll set this later, but the rate of inflation we're going to use across the whole thing is 3%. That's not a prediction. That is nothing more than me picking a number, right? The key to this screen is remembering that when you enter a conversion amount, or in some other places an income amount, the system will assume that what you have entered continues in perpetuity until you tell it to stop, right? And so in this case, we're actually going to be doing 3 lines, right? We said we were going to have a $200,000 conversion. That's actually going to go through 2027. Right, because in 2028, the second spouse is going to start collecting her Social Security, which is targeted at about a $40,000 amount. So we're actually going to scale back down the conversion by a little bit, right, to stay within that where we thought might be the top of the 22% bracket. We're going to apply that and then add our final row, which is when those conversions stop, right? Because if I didn't do anything, the system is going to assume I'm going to continue doing conversions forever and ever and ever. So in my stop year, which is 2030, I'm going to say no conversions anymore at all. And then when I hit apply, my chart down below is going to map out those different conversions. So we've got a couple of years of $200,000. We scale back down. These are the inflated amounts, and then the conversions stop entirely here, right? So we've modeled our conversions. Now we need to know a little bit about asset information. And the reason we need to know about asset information is because in a screen or two, we're going to be entering a spending assumption. And that spending is going to be accomplished by the income streams that we've got. So Social Security, pension, if there was any, annuity income, if there was any, and assets. So for these 2 folks, we are going to assume $500,000 of assets. I'll go back and fix that with $300,000 of cost basis. Cost basis is important, right? Because this is a tax planning program. We need to know how much of a gain somebody is realizing when they are liquidating taxable assets so that we can apply the right tax rate to that and have that factor into the projection. On Robert's side, we're going to give him $1 million of tax deferred assets. On Roxanne's side, we're going to give her $750,000. And we're going to assume that they have some small amount of Roth already in the bank, right? So that's our asset side of things. Got to do a few more things. How much do we think things are going to grow? We're going to give these folks a 6% rate of return. That's the easy part of this screen. The more, I'll say complicated, but I think the more thoughtful part is on this right-hand side, where we say the portion of the returns that are capital gains, right? Because, when we think about returns from a total return perspective, your return is made up of growth, but also of income and dividends and interest. So, if you believe that some portion of your returns are going to come from growth and some are going to come from dividends and interest, you'd want to indicate that, because those things are going to be taxed at different times, right? Capital gains are going to be taxed when you liquidate, but income inside of a taxable account is going to be taxed in that particular year, right? So in this case, we're assuming that 20% of the returns are from capital gains, meaning 80% of the returns are going to come from income and dividends. Again, when you see a default number in here, that is not Holistiplan saying this is what you should use. That is just us saying, here's a number, right? So you want to put some thought into this about your particular portfolios for particular clients, right? Is 6% a reasonable assumption for a rate of return? Who knows? For some of you, it's spot on. For some, it's too high. For some, it's too low. Same thing is true on the other side, right? How much of your return is going to be capital gains and how much is going to be dividends and interest? This is really on you to determine what your investment philosophy and approach is going to mean for your clients. For the purposes of this case study, we're going to leave it at 20%. Some additional details about Robert. We're going to assume Robert's going to live a long time, all the way out to 100, but he is already collecting Social Security. So we're going to enter 2025. Now, last year he collected, I think it was $45,000. So internally we have to apply, the 2024 to 2025 cost of living adjustment was 2.5%. So that would mean in 2025 he's going to be collecting $46,125 of Social Security. For Roxanne, we're also going to have her live out to 100, but she's not going to collect Social Security until 2028. And her benefit amount in today's dollars is going to be $40,000 as well. All right. So far, so good.
Yeah. And, Ben's kind of going, it's admirable, Ben, that you're trying to lay in some of these methodology type things, 20% of capital gain stuff. I mean, we're not going to be able to go into all the detail. There's another question that came up that's a little methodology-ish. We intend to do a separate webinar for the nerds who really want to dig in. And by the way, the nerds also, we've got it at the bottom left, there's that export button, and you can actually see every single individual intermediary calculation within the Roth projection. And if you really want to dig in, it's all there. So if it seems like we're glossing over some of the math, it's not because we don't believe in the math behind it. It's just that we think it might bore people to tears, and also we only have so much time. We're trying to show the concepts of how you would build a Roth projection and then actually implement it within scenario analysis. So I apologize to the folks who want Ben to go into detail on how this number impacts that thing and all that stuff. I promise it's all there, and we have confidence in what's all there, and we try to be very transparent about what's there. I don't know if it's going to fit in with this audience in this call. I'll just leave it there.
Yeah, I think last time I checked, there were over 1,300 people involved on the call. So, if all 1,300 are
no, you've lost 800, Ben. Once you start talking about that 20% capital gains thing, they were just all running for the
gets everybody. But assuming all 1,300 were still there, man. Yeah. Well, I mean, go Birds. But assuming everybody was still there and wants to nerd out, we will nerd out with you until you are tired of us.
In another call. We'll do
another call.
Yeah.
All right.
All right. Keep rolling. Sorry.
No problem. So last couple of variables we need to enter here. We're going to assume that they want to spend $100,000 because that's nice and round. And I said before, we're going to use a 3% rate of inflation. Last piece, one of the more challenging things for folks to wrap their heads around, but I think, this is one thing that we believe is critical, even though we make it optional. We think people should know what we're at least trying to get at here. And that is the tax adjustment assumption for tax deferred accounts. Now, we mark it as optional, right? You don't have to turn it on, and you can turn it on and off later as you want to. But the idea here tries to get at $1 inside of a traditional IRA is not worth the same as $1 inside of a Roth IRA, right? Roger, when you were talking to, clients, when you were doing this, you would talk about the fact that, if I remember, and I'm going to paraphrase instead of quote, but, the IRS owes some of your IRA, right? There's an embedded tax liability inside of your IRA that you should probably account for somehow.
Right. And it grows every year. Their share grows every year, and so you can buy out that business partner right now. Yeah,
That's right. And so the concept of this screen, this field right here, just says if you want to see your IRA adjusted for that embedded tax liability, you can do that. And you just have to enter the single rate that you want to adjust it by, right? So we can make it 24%, we can make it 22%. Again, for the purposes of today, it doesn't matter, but we're going to leave this off for right now just to start, just so that if you want to, we can show you what it looks like when you turn it on. And we'll talk through that again. There's a whole methodology behind that. Try not to get too bogged down in that. But again, we promise you, if you want to nerd out, we will nerd out with you.
Like if the child, there's a couple ways you could look at how you enter this field, but like if the child is in a super high tax bracket, for example, well, then the child inheriting these assets would value Roth even more than a tax deferred asset, right? So, there's arguments for how you would want to model this adjustment at the end of life.
Yep. So we're gonna leave it off. We'll turn it on when we're actually inside the projection. The last one, this is kind of funny. We've been leaving this on by default for really forever. But hearing Jeff talking about it, he said turn it off. So we're gonna turn it off, right? So, but in turning it off, what I'm doing is I'm no longer assuming that the 2026 tax rate sunset, right? So we are assuming, for the sake of this projection, that the TCJA tax regime goes on in perpetuity, which we know will not be the case forever, but it's what we know right now, right? So we're going to do as best we can with that. When we hit complete, that is going to create a number of charts inside the Roth projection. So the first one that we see, the one that's up at the top, is the projected tax bill in our base case, which is going to be in this light green, and then the Roth conversion, which is the blue. You're going to see on this axis, that's going to be your tax bill in any particular year. And then as we scroll across, we're going from left to right, from the beginning of our projection period into the end. The Roth conversion starts with a higher tax situation because we're doing those conversions early on, but then it drops, right? On the green side, there's very little tax paid because, again, right now these folks are spending down their taxable assets. They're in a low taxable income situation, so there's a 0% capital gains rate for a lot of these things. But then we see that their annual tax bill starts to go up and up and up as we turn on both the second spouse's Social Security and as both start hitting required minimum distribution age, where they have to take money out of their IRAs, whether they want it or need it. And when you add everything up, the base projection, the total lifetime tax, is about $1.9 million. On the Roth side, it's only $1 million. So we've got a projected difference of $883,000 in taxes. Now that's just the taxes side, right? That's important. But we also want to take a look at just the straight up portfolio value. And again, we've got our green base case, our blue is the Roth conversion case. And sometimes, when we started walking through this with people, I think some folks were surprised that the base case stayed ahead of the Roth conversion from a portfolio point of view for a longer time, I think, than some folks were expecting. But if you think about what's happening here, particularly with larger conversions, right? When you're doing a larger conversion and paying more taxes on that conversion, you're taking money out of the game, right? That's an opportunity cost where that tax bill that's paid no longer can compound and grow. Now, if you wait long enough with the right circumstances, you make up for it, right? So here we've got our left to right, from 2025 through the end of our projection period. It gets a little not confusing, that's not the right word. It gets a little misleading. Help me out, Roger. What's the synonym? The scale here is in $2 million increments, right? So what looks like a very small difference is actually much larger than it might otherwise appear, right? If I'm looking in between here and here, well, there's $2 million between here and here. So a very small difference here is actually going to translate to a pretty decent amount of money, right? $700,000 difference. And you see that, I think, a little bit more in the second, and this is actually why we built this second page or the second chart to expand on this. The portfolio value difference is just taking your base portfolio value minus your Roth portfolio value, right? So anytime that anything where you see a negative number in the portfolio value difference, that is when the base case with no Roth conversion has a greater amount in the portfolio amount, right? And so that's what we see here. The Roth is losing, if we're just comparing portfolio values, nominal portfolio values to each other. It is less than, right? So that Roth conversion is less than until about 2048, at which point it goes positive and then goes positive, considerably, right? So about $671,000 if we modeled all the way out to the end of our scenario, right?
Ben, some methodology things that are coming up. I just because I saw a couple of overlaps on like, how are you handling some of the taxes being paid out of taxable funds, but then you might have to raid the IRA to pay the taxes. Like that's all built in. And so if you had a case where you were raiding the IRA to pay taxes for the Roth conversion, that of course would look a lot worse. So again, another call, we'll go through methodology as deep as people want to go. We can go like literally line by line in the calculation. I just don't know if we're going to be able to do that to the extent people need us to today. There was a good point about like, could you scroll up, Ben, like that total lifetime tax difference, which is awesome, dude. That's such a cool big number, but it's true. It's future dollars. We know.
Yes, we know.
But boy, is it really impactful to sit with your client and be like $883, but it's true. That's future dollars. And so that's a roadmap thing. We haven't added it yet, but it'll be a toggle. You can discount it back. Although, you're trying to make a big impression on people, hit them with that future dollar,
Yeah, but,
actually make it way in the future. Like in the year $3,000, it's $8 trillion difference if you do the Roth.
Yeah, but we want truth, justice, and the American way
All right,
here at
go ahead.
Holistiplan, Roger. So
Keep
we'll yes,
rolling.
know that it is on the roadmap to bring things into
Yeah.
present value. So a couple of other toggles before we get to the some of the new things here. If you wanted to show, one of the advantages of doing these Roth conversions is a few lower RMDs in the future, right? So I just toggled on RMDs on the left-hand side. That is going to add a required minimum distributions chart itself, where we can see, as you would expect, the RMDs are higher in our base case, lower in the Roth conversion case, because in this case, the conversions were such a high amount that we brought down, I think, the first client's tax deferred assets to close to zero, right? You can also show for those situations where the major impact is in the end of the scenario as opposed to the beginning. If you wanted to focus on that, you can highlight the only show last 5 years toggle. We hit apply, and that is going to do some expansion. Here, now we're just looking at the last 5 years instead of starting at the 2025 year, right? So you can see that projection, that difference a little bit more magnified because we've changed our scale, right? The thing that we wanted to talk about, in addition to just giving everybody a refresher course, is we've added the ability to bring in Medicare assumptions to our projection. And we're going to walk through that again. We can get through the methodology and all this if we want to, but there are going to be two elements to Medicare that we can factor into the projection. The first is Part B. And so if we want to start calculating Medicare Part B for client one, we click the box, indicate the year that somebody's going to start Medicare. And you might be wondering, why are you doing that? Doesn't everybody start Medicare at age 65? No, right? Folks that are still working at age 65 don't necessarily have to start Medicare depending on the health insurance at their employer, right? They might have to start Part A, but Part A is free, right? There's really no cost associated with Part A. Part B is a little bit different. So even though most folks will be starting at 65, we wanted to allow for those folks where they might not be starting exactly at age 65. We're going to do this
if they're on Social Security disability and they start taking it
or
early,
before, right? The second part is going to be for Part D, right? Now, Part D is a little bit harder, right? We don't know what your client's Part D premium is. Your clients might not know what their Part D premium is, but they're going to be a better source than Holistiplan is. For the purposes of today, I'm going to use the average Part D premium was actually like $46.50 per month, according to the Centers for Medicare and Medicaid Services. That's going to annualize to about $560 for the year. I'm going to do that for both clients. Again, if you know your client's specific Part D premiums, you're going to want to go ahead and enter those for a little bit more accuracy. But the reason we want to enter these things is so that we can apply not just the cost of the Medicare itself, but the big bugaboo that everybody gets terrified of, IRMA, right? These income related surcharges, where as your income goes into higher and higher brackets, and specifically it's your Medicare related modified adjusted gross income, which is your AGI plus any tax exempt income, you have to pay surcharges on top of your baseline premiums, right? And that's what we're illustrating here. Those high conversions in those first few years push these folks into a surcharge bracket where they're having to pay IRMA. but then they drop out of it and never have to pay it again, right? Because their RMDs were brought down by so much, they have eliminated IRMA for the rest of their situation, for the rest of their projection. In the Roth side, but in the base case, they have to pay, when they start getting into, 2024, 2045, and those RMDs are kicking them up a notch, right? Because remember, we're inflating everything all at the same rate. Now, yes, same thing is true. We're looking at a total dollar amount that is not brought back into present day. We know that is going to be that is on our roadmap for the ability for folks to be able to do that. But one of the reasons why we wanted to show this is because, one of the feedback pieces that we get so often when people are talking about Roth is like, well, what about IRMA? What about IRMA? What about IRMA? Totally get it, right? IRMA is a thing. It is a thing that is out there. But hopefully one of the values of a tool like this is for you to be able to say, yes, you are going to have to pay an IRMA surcharge for a couple of years, but it is so you can have $700,000 more with our projection by doing these Roths, right? Now, again, this is one case. Your mileage may vary. Not everybody's going to have an optimal outcome, but it's trying to give you another tool in your toolkit to have these conversations with your client and to maybe get around some of these things that we're terrified of that might not be as scary as they really are, right? Roger, was there anything that you wanted to add here? Because if not, I'm actually going to jump back into the scenario analysis part of this.
Yeah, go ahead. As you're doing that, I'll hit. There's a theme of a few questions that I won't be able to fully address, but some of the questions are along the lines of, look, I use this other projection software, and how does this compare to that? Like, look, I haven't built a whole like who can do what chart on who can do what basically. And I'll talk a little bit at the end about our intentions with where this product goes. But I'll just say this, like one of the things you can count on underneath the covers of this projection engine is a very strong tax engine. Okay, like it's built on top of the same tax engine that you use for Holistiplan for scenario analysis, which is what Ben is on now. So if I were to come up with a like one sentence differentiator is like all I know is like the foundation of the tax piece of this projection engine. If you trust what we're doing within this screen that Ben's on scenario wise, you should have confidence that we're doing the right things with taxes and with those IRMA premiums underneath the covers. Now, all the other stuff, we can get into all those. That's where some of the differentiators could be around user friendliness. And someone wrote something about, well, I want to put a different investment strategy in the Roth account versus this. Like those are kind of the details that you can get into as you evaluate different tools. I'm just saying, like, if I were to in one sentence differentiate the two, look at the tax engine at the bottom. Like that's a thing that is rock solid for us. Everything else we're building on top of that, it's user friendliness, it's completeness around that sort of thing. And again, I'll get into this more at the end if there's time. Go for it, Ben.
So what we're now going to do is we're going to go from that zoomed out to our zoomed in, right? Scenario analysis is our projection tool where we're going to say, yeah, we had this goal of doing $200,000 of Roth conversions each year, but is it really going to be $200,000? What might I need to think about before I just blindly say a $200,000 Roth conversion, right? Makes sense for my client. So I've already created a 2025 scenario for Robert and Roxanne where I'm assuming the same level of investment income from last year. Now that might not turn out to be true later in the year. Can always go back and fine tune that. But I've adjusted Robert's Social Security for the amount that he's going to be taking this year. From here, we're actually going to go to Holistiplan's range calc tool, which is accessible in this additional options menu in the upper right-hand corner. It's the second option down. What range calc allows you to do is visually see the impact of adding increments of additional income from your existing baseline. So in this particular example, this 2025 baseline, Robert and Roxanne have taxable income of about $14,000, but no ordinary income, right? That's what this zero origin spot refers to. They are at zero ordinary income. So as we move from left to right, we are adding increments of income to that baseline amount of $0 of ordinary income. What I'm seeing is a visual representation of the taxes that will impact Robert and Roxanne with each $1,000 increment. And there's a couple of different colors going on here. The blue is going to be just the regular marginal brackets, right? So 10%, 12%, 22%, and so on. This purple reflects the fact that because they are so low income at baseline, as we add additional ordinary income, that's actually going to change the taxability of Social Security. which is in its way a tax increase, right? As we add more income, more of their Social Security benefit is going to be subject to taxation, up until the point where they hit the maximum amount of 85% of their benefit is subject to taxes. So that as I move from this point on to the right, I see the purple section disappear. What that means is as I add more income from this spot going to the right, I'm not changing taxability of Social Security anymore. The red section just has to do with the fact that as you've added more ordinary income, you're changing how capital gains are taxed, right? You've pushed taxable income up to the spot where we move from 0% to 15% taxability of capital gains. The vertical lines that you see are the thresholds where those IRMA surcharges start, right? So as you go over by $1, the IRMA surcharge kicks in. What I'm doing here, though, is I said I thought maybe $200,000 was going to be the right amount of a Roth conversion. If I did that, that actually puts my client in the 24% bracket, and that might not be my goal, right? I might say I really want to keep them in the 22% bracket. So I've got to scale back some to at least $191,000 of a Roth conversion. And if I look at this still, I see I've got this brown section. This brown section indicates that I've added so much income that I'm subjecting my clients to the net investment income tax, right? Because I'm over $250,000 of adjusted gross income for a married filing joint couple. So if I don't want to do that, I've actually got to scale back to somewhere closer to, $177,000, $178,000 of a conversion. Now, if I were going to do this to completion, I would build another baseline, I'd build another scenario, and I'd enter that dollar amount. But we wanted to at least give you the visual of, okay, we thought 200 was the right answer, and that was a decent enough projection. And maybe 200 is still what I want. Maybe I don't care about the net investment income tax, but if I really wanted to stay within the 22% bracket, if that was my goal, I've got to scale this back to somewhere closer to like $190,000, $191,000. And the idea would be that you kind of have that 200,000, 160,000 conversion plan that we talked about on that first screen, but each year you're going to come back to this and fine tune that a little bit, right? It's not always going to be $200,000, right? It's going to depend on what else is happening in that particular year. So we're going from that zoomed out to that zoomed in, and now we've got kind of that more precise, this is exactly what I wanted to get at with this Roth conversion strategy.
Yeah, and Ben, Ben started with $200,000 as the, the goal. Remember, we had a conversation 3 years ago with our client. They said we're going to do $200,000 Roth conversions every year, and now we're kind of getting into it. And you're sitting with the client, you're like, maybe not 200,000. Sometimes though, you're also maybe actually even more frequently, you're saying, look, let's just fill a bracket. And Ben, actually, let's go back to that 12 and the same screen. Like, let's say that your plan. This is a really good example of where range calc gives you some information that you could. Honestly, like advisors are probably missing if they're not, because if your plan is just, I want to add enough Roth conversion to fill up the 12% bracket, that's a super common strategy, right? Because jumping from 12 to 22 is a lot. So if your plan that you mapped out with a client was just like fill the 12% bracket, that would be an $81,000 Roth conversion. But here's the reality. The reality is you're actually paying 27% on that Roth conversion for that last few $1,000s. You're not actually paying 12%. That's what range calc is telling us. What that orange thing is telling us, just to be clear, hey, what'd you do to me, pal?
I messed it up.
What was happening there was because I brought enough taxable income. Remember, the taxation of your capital gains is based on total taxable income. I brought enough taxable income in that suddenly my capital gains became taxable. And the more income I'm adding, the more capital gains I'm bringing up from 0 to 15%. If Ben had widened this, by the way, you'd see another orange spike going from 15 to 20, like way out, farther out. Anyway, the point is, you can model this all out in whatever software you want projection-wise, and you're like, we are going to fill the 12% bracket this year. But the reality is there was some event that happened where they sold an asset. And the reality is if you did that $81,000 conversion, you were actually spending 27% on that, which was not the plan. So right now, Ben, go back to what we should actually do. We should do a Roth conversion of $58,000. That's what range calc does for us. Now we've done, again, we've taken strategic and taken it down to tactical. We've used the information we have about this year. And now we're saying, I'm going to do what was it, 57,000? I have a bad memory.
Yeah, 57.
57,000. That's the scenario we draw up. That's what we go back into scenario analysis. We share with the client, look, 57,000 is what we're going to do. And then that's how we actually implement what the plan was that we developed with the client. It's taking strategic down to tactical. for years, all Holistiplan could do was this tactical piece, which a lot of advisors value. Don't get me wrong, like that's our bread and butter. But we built the projection tool because enough advisors were saying, look, I trust you on this. I want the full experience of this Roth analysis to happen within the software. So that's why we're building out and have built out that Roth projection tool.
Yep.
All right.
And so, Roger mentioned, we've talked about this, a couple of things that are already on our roadmap. We've mentioned, the ability to express these in current dollars as opposed to just the lifetime dollars, right? So acknowledge that we want to do some present value. This is not ready for prime time just yet, but, one of the next iterations that's going to be built into this is the overlay of tax brackets, right? Tax rates on the year of the conversion so that folks can get that sense of like where those different tax brackets are going to land, right? So we've got all the different tax brackets right here. Again, this is not, don't take a snapshot of this and say like, this is exactly what tax rates are going to be, but it's us trying to give you a sense of like, what is next coming through in this Roth projection tool, because there's still a lot more that we can do. A lot of things that we're excited about, and we want to keep building on this because what we're hearing is we like this, but we want more. We like this, but we want more, which is great. Like we want to give you more, right? So this is also going to be coming down the pipeline. Roger, is there anything else that we want to talk about in terms of roadmap with the Roth beyond just the, yes, we will have the nerd out methodology call for anybody who wants to bring their pencils?
No, the thing that Ben just put on screen, we're super excited about, and all the math behind the screen, behind the scenes is there. It's just a matter of putting it on the front end for a way that people can interact with it. So like the heavy lifting of what Ben has on screen is done. And then of course, what people are going to ask for, which we're excited about, is like, okay, don't make me manually fill that 22% bracket. Just tell me how much Roth conversion fills it. And then you starting to build in some like automation, optimization stuff. That's what we're super excited about. So let me come back to some of the questions that I saw about like, how does this compare to other products and all that stuff? Those other products have been in the market for 20 years and I've used some of them myself. And so like, they're out there, but I will state our intentions maybe more clearly than I did last fall. When we had first announced this tool, by the way, we did have a Roth conversion tool, which you could attach to a scenario. Now we've had that for multiple years. This is the ability to kind of build an independent scenario. I kind of soft pedaled last fall about what our intentions are. We don't build products for marketing purposes. We build products because we want to build a full featured product. Like if our advisors are asking for a thing to exist, I'm not going to build a lame version of it just to say we have it and do a press release. Like we want to build a full featured tool. And so it needs to be as good or as better as what else is out there, or we wouldn't do it. I would argue that, again, the tax foundation of this tool is as good or better than anything out there. Again, there's pieces we need to build out on the kind of giving people more flexibility on functionality and stuff like that in terms of building in their assumptions. Why are we doing this? I said already, Roth conversions is the primary thing people are doing in our system. And the reality is tactical tax planning does not happen in a vacuum. Like these are, sometimes you're making a choice to bring income into a year in hopes of saving later, right? And we have to be able to show that full story. And for years we said, go use another product, but our own customers have told us they want us to build it. And also here's another reason why we're doing it. It's freaking fun. So, like this is why we do what we do. Like we want to build something special. And we have visibility into building something special. Like I see great momentum in terms of what we can do here. And that's why we love what we do. It's the adventure of building this stuff. So I would just say, watch this space. We're locked in. We're having fun doing it. That's a dangerous combination in a good way, because we're going to keep going. And so, yes, again, watch this space. And yes, if you are interested in this being the best it can be, and you feel like you want to be a part of that, yes, there'll be this methodology call, but like, let us hear from you. Like, I would love for us to build this thing together. The whole reason this exists is because you asked for it. Maybe not you personally, but an advisor like you in our software asked for it. And we got excited about it, and we're building it. And I want to make sure that we continue to listen to our customers as we do that. And make sure that it really does interact. I saw some good ideas just in the chats on like how pieces can interact across the software. So again, watch this space, but let's see people start to use it this year, and we're going to continue to give you trickle out our updates on how it's coming along. That's all I got, Ben.
Very cool. Laura, I believe we might need you to come back in and to officially send everybody home, because I don't think I have enough power to do that.
Right.
Yeah, I can help with that. Thank you, Ben. Thank you, Roger. It's always so great to hear from you guys, especially not just how the product works, but what is the product vision. And I think that's so important for advisors to hear that we want to be the best in the market. We think we're the best in the market, and we're just going to keep driving towards that. So it's something that we continuously invest in, that we're going to keep investing in. All right, so this is the slide to bring us home. This is the code, the promo code. You should write it down. If you don't have it yet, take a screenshot. Web Keynote 2025. This will get you 10% off for your first year on premium. You should sign up today. Let us know how it goes. If you need help, we have a great support team. We have a great CS team. So I think that's a wrap. We'll send out the recap with the recording. We'll send out the recap email with any of the questions that didn't get answered. We had well over 100 questions, probably 200 questions or so. And so we'll pick probably 10 to 15 to answer, and then we'll send that out in the recap email. And this video will also get posted to our webinars page. So keep your eyes peeled for that. But thank you so much, everybody. It's been awesome having you here, and happy tax planning.
Thanks, Laura. Thanks, everybody.
Thank you, Laura. Thank you, everybody.
Bye, everyone.